So, folks, let's just talk for a second. Last week, we were ahead of the game and we went ahead and got into financing. And so that's where we're going to pick up again today. Let me warn you again about financing. You already kind of figured this out last week, and hopefully you figured this out a little bit more in your studies. The financing chapter and the agency chapters, hands down, the worst chapter. And the problem is agency at least has the ability to be associated with other concepts, right? It's pretty easy to grasp once we tell you about like what an agent is and these loyalties, and you can kind of relate it to something. The problem with financing is the way that it actually works and the way that you've always assumed that it works are typically completely different, which makes it difficult, right? Like the mortgage, what you thought was a mortgage is not in fact a mortgage. And so my recommendation to you is you need to spend a lot of time studying the financing chapter. We're going to pick up, we're going to continue, but there's just so much in it that you've got to just, when I upload the videos or Travis's videos, I would suggest going to that financing chapter and just playing it in the background. Like if you're driving and you're traveling, pull it up on YouTube, play it in the background. If you're cooking dinner and you got some time, play it in the background, because hearing it over and over again is going to make it a lot easier to understand. Like that is absolutely the best way to get a grasp on this financing chapter, because there's just so much in it. There's so many different concepts, and it's just, like I said, you don't have the ability to so too many other things because of how unique it was. So that being said, let's kind of remind you what we talked about in general. Last week, when we got into financing, we started talking about some of the principles and concepts associated with it. And so we talked about financing is when you borrow money to purchase a house, which most people do. You can always pay cash, but I do want to make sure too that you understand that in the eyes of the seller, it's always a cash sale. Because if you think about it, the seller is making cash no matter where the money's coming from, right? Because the bank's going to give the buyer cash, and then the buyer's going to use that cash to buy a house, or the buyer's just going to pay cash outright. And so the significant part of financing isn't really affecting the seller, it's the buyer and what that means for the buyer. And so we got into these concepts of the promissory note, and the note is the debt and the promise to pay it back. And so when you borrow money, you give this promissory note. Remember those images we looked at. You give this promissory note to the bank, and it is a type of a contract. And we're going to talk more and more about contracts in the future. So you give them this promissory note, and the promissory note can contain, needs to contain all of the loan payoff and financing information, like interest rate, terms, right? How long you have to pay it off, all that jazz. The other thing that we said that these promissory notes sometimes contain is what we call clauses. And there was a couple different clauses that you could put in a promissory note. How about this? What did we call the clause that says, pay us everything now?
Acceleration.
Acceleration. That's exactly right. The acceleration clause. Remember, accelerate means to speed up. And so while you may have had 30 years to pay it back, now we say pay us now. And that is typically due to some kind of default, whether you didn't pay or something else in the promissory note that you weren't supposed to do that you did, causes the acceleration clause to kick in. It says pay everything now. What about the clause that says because you're giving away the ownership, you have to pay us now?
Alienation clause.
Alien clause, also called a what?
Due on sale.
Yeah, due on sale clause. And so if your loan is assumable, it would not contain an alienation clause or due on sale clause, because that would allow somebody, even though you're transferring ownership, to take over that loan. But if you contain an alienation clause or due on sale clause, your loan is not assumable. And that means that when you sell it, you have to pay it off. Remember, the alienation clause is prohibited on government-backed loans. FHA, VA, and USDA are all assumable, legally speaking, and they can't contain that alienation clause. And then the last clause that we talked about was a prepayment penalty clause, which says if you pay this off early, you may have to pay some penalties, because banks are in the business of making money. And so they're getting their interest as you get the loan over the life of it. And sometimes there is these prepayment penalties that say, you know, we were supposed to get all this interest, but you didn't give it to us because you paid it off early. So we're going to penalize you and we're going to make you give us some money. That one is rare, also prohibited on government-backed loans, but it does exist in some types of loans. So the other things we talked about, aside from the promissory note and the clauses that go in there, is the security instrument. And the security instrument is what you call a lien on the property. And so a lien is basically when somebody has the right to go after your property because of some amount of money that you owe them. And that's what your deed of trust and your mortgage were. So we were talking about deeds of trust and mortgages, and those are the liens that are attached to real property. And the deed of trust is what we use in North Carolina. And so the deed of trust was a three-party instrument. Who were the parties for the deed of trust in a title theory state?
The buyer, the lender, and the trustee.
The buyer, the lender, and the trustee. And trustee is the only name for that person, but the other two have other names. What do we call the buyer in that same relationship of the deed of trust?
Grantor.
The
Grantor.
grantor. Why?
Because they're paying.
They're granting the collateral.
They
getting
are
the title.
granting the legal ownership for the collateral over to the trustee, right? Remember how this works. When you buy in North Carolina, you get legal title, grantor to grantee. You as a buyer are the grantee, and you have legal title for like that long. And then you're conveying that legal title to somebody else, which is the trust. That's why we call you the grantor. So we give the trustee naked legal title is what we call it, because they are holding legal title, but possessory interest stays with the borrower. So they're still treating it like their own. They're still occupying it, nothing doing, but somebody else is holding legal title, and that's the trustee. What's the other name that we call the bank, the lender in that deed of trust relationship? There you go.
Beneficiary.
Beneficiary, because the trustee is holding the title on behalf of the beneficiary of this legal agreement. It says if the borrower defaults, the bank just tells the trustee, and the trustee will force the sale on behalf of the beneficiary, which is the bank. So then we had the lien theory states, and in the lien theory states, we don't use a deed of trust. We use the true mortgage. That is where a mortgage actually exists. And so the mortgage is a security instrument. In both of those states, the borrower is giving the bank a promissory note as well as something else. And so in these mortgage relationships, how many parties are there?
Just two.
Just two. Who are they?
The
The
mortgagor, the
mortgagor.
mortgagee.
Correct. Who's the mortgagor?
The person like that's getting the home.
The person that's getting the home?
Yeah.
Yeah. The borrower is the mortgagor. The borrower is the mortgagor. Remember, the borrower is giving the bank the promissory note and the mortgage. The mortgage, remember that word hypothecation, pledging, the act of pledging, so the home is collateral. And so the mortgage is actually an interesting one because you're pledging the home as collateral. Everybody knows that it's collateral, but you still retain legal title yourself. So the borrower is the mortgagor, and the borrower gives the mortgage to the bank, which is why the bank is the mortgagee and the borrower is the mortgagor. And they also give the bank the promissory note. Well, what are the banks giving you?
Money, loan.
Money.
Money
That's it.
by the house.
Money.
Yeah.
They give you the loan. So we talked about the difference between these states. The big thing about these, aside from obviously being on the test and the verbiage and everything that goes with them, the biggest thing about these is the big difference is how you foreclose. That's it. You would never know any difference living in a lien theory state versus a mortgage theory state. It acts completely and utterly a lien theory state versus a title theory state. It acts completely and utterly the same while you're paying everything. But if you stop paying, the way they foreclose is the key difference. Because remember, in lien theory, is what's called a judicial foreclosure. They have to go through court and get legal title back to sell it. In North Carolina and other title theory states, we have a power of sale foreclosure. It is very easy. It is not non-judicial. They've already got legal title. So those are the big differences in those, which led us up to, let me get my slides right here. Led us up to where, you know, we were just talking about this redemption period. Obviously, whenever you're in default and this due on sale, I'm sorry, not the due on sale clause, the acceleration clause kicks in, they say pay us everything now. You can prevent a foreclosure by paying everything now, but the likelihood of you having that money is slim to none. So when we're dealing with this, there's this redemption period. It's just almost never going to matter because most people are not going to make money. But in North Carolina, we've got that 10-day upset bid period. When it goes to foreclosure and auction, after they say, you know, sold at the auction, they actually wait 10 days, remember, for anybody else to go down to the courthouse and to put in an upset. Anytime that an upset bid is put in, that 10-day period starts over, and during any subsequent upset bid period, the borrower has the right to pay it off completely and avoid that foreclosure. So that was the last things we talked about last week. And then the deficiency judgment. Remember, when we deal with liens, we're going to talk about liens a lot because mortgages and deeds of trust are just one type of lien. And they're called specific liens. And they're called specific liens because they attach to a specific piece of property. They don't attach to a person, piece of property. But if anything was to ever happen where they were removed from the property by way of a foreclosure, we extinguish those liens at foreclosure, it doesn't mean that the money that you owe disappears and people forgive it. That's not what happens. It means that the individual people that you owe money to could go to court and file a deficiency judgment. And a deficiency judgment is a general lien that goes after all of your assets, right? As opposed to just that piece of property. Now they're going after you and your assets. And a deficiency judgment can happen, and if a deficiency judgment can also happen in a short sale. And that's where I think we kind of left off because I felt like I was, you know, making you learn so much last week. And then I think we did like a little bit of review with the Kahoot games with agency. So remember, a short sale is kind of an ironic name because what it is, it takes a long time. So it's not short in the amount of time it takes. It is short on monies. In other words, short on funds to satisfy all liens. That's why we call it a sale. So it is more difficult the more lien holders you have for this short sale, because they would all have to voluntarily agree to the short sale. You can't ever force the lender or the, you know, the people, the lien holders to allow a short sale, but you can ask them to. And remember, the reason we said they may go for that is some money is better than no money. And at the end of the day, if you're in a lien theory state, judicial foreclosures can be very time consuming, costly, and problematic. So it's sometimes a lesser of two evils. And understand that short sale is also material fact in North Carolina. So if you were trying to sell anything by way of a short sale, would absolutely be a material fact. Which leads us into section 6.2, which is where we're going to introduce a couple of different things. And I'll tell you what, there's a lot of information in the rest of the financing chapter, but the vast majority of everything else is what I would consider more flashcard level stuff. Except for the math. Obviously, we're going to talk about math and things that go with it. But when we're dealing with different types of loans and repayment plans and, you know, these things, that it's basically going to be recall and differentiate. It's not going to be super analytical questions in any way, shape, or form. It's just flashcard level stuff, which is arguably better in most cases. So let's kick it off. So when we're talking about buying the house and paying for the property, and let me move my screen because I'm not on the center and it's driving me crazy. There we go. I already told you that buyers can pay cash and buyers could also borrow money from a bank, which is what normally happens. Buyers can borrow money from the seller, called seller financing. And there's a couple of ways that kind of works. There's true seller financing, and there's what we would call a contract for deed, which we'll talk about more. We've also talked about loan assumptions. It is possible that you could assume somebody's existing loan, although it's not very common at this point. I would say that there'd be a very likely resurgence of this. And I just want to remind you what that looks like. If you were dealing with a loan assumption, and let's say a $500,000 house, but they put $250,000 down and they got a loan for $250,000. So if you were assuming somebody's $250,000 loan, understand that they're not just going to give you their $250,000 in equity. And so what happens is if they've got a loan at 2.5% for $250,000, they would allow you to assume this loan, would need to get another loan to pay back that $250,000 in equity, arguably at whatever the current rate is now, 6.6 or whatever. And the positive thing to this is even though you would now have two different payments to make because there's two different loans, it's cheaper overall than having a 6.6% interest rate on $500,000. That's a hell of a lot more interest that you have to pay each month. So that's kind of how a loan assumption works. It's typically people are getting a second loan, pay the difference between what you're purchasing for and, to get their equity out of it. So loan assumptions do happen, and with like the all-time low interest rates where they were, and then the much higher interest rates where they're at now, I think it's very possible that we could see a lot of loan assumptions coming back over the next couple of years. This is also another, much less common kind of way of looking at it. Buyer can take ownership subject to the where the buyer makes a payment on the seller's loan, but the seller remains legally responsible for the debt. We're going to talk about this some more in just a second. I don't think it's something that you really need to be worried about. I just don't see them talking about that because that's exceptionally rare in all facets for sure. So a lot of different ways that you could potentially buy a home. So we just talked about the assumption, and in the assumption, you have to have lender's approval. Please understand that just because a loan's assumable doesn't mean you can automatically assume it. You have to qualify for it. So number one, the loan has to be assumable. Number two, you actually have to qualify for the assumption, just like anybody else would, because the banks need to make sure that you can pay it off just like anybody else could, just like the previous owner of that note could. And other than that, it's pretty straightforward. After you qualify, they just transfer everything. There's some paperwork involved in it. And the other interesting thing about loan assumptions is the way that interest is handled at closing. And I'm going to talk more about that when we get into the math piece, because interest is kind of the biggest math piece in here. There's also qualifying a buyer, which is something else we'll talk about. But other than that, assumptions are pretty straightforward. So when we're dealing with loans, the way that we articulate them and the way that we articulate them in the real world is what we call loan to value ratio. And so if I was to say something like an 80% LTV, loan to value ratio, I want to explain to you what it means. The banks are willing to lend you 80% of the purchase price or the appraised value, whichever lower. So if you ever hear somebody say like a, 20% conventional or an 80% conventional, it depends on what context they're talking. But a conventional loan, most commonly, the standard one is you're putting a 20% down payment and you're borrowing 80%. So if it was a $500,000 house and you were getting an 80% loan to value ratio, all you're doing is percentages, $500 times 80%. You would be borrowing $400,000 from the bank and you would be bringing $100,000 of your own money as a down payment. That is what 80% LTV. If we said it that instead it was a 90%, because sometimes that does happen as well. There are conventionals with only 10% down. And so if we were looking at that, $500,000 times 90%, you would be borrowing $450,000 and bringing $50,000 of your own money, so on and so forth. That's what the loan to value ratio means. But let me explain what I said, that it is the purchase price or the appraised value, whichever is lower. So if you agreed to buy a home for $500,000, but it only appraised for $450,000, meaning an appraiser said, nope, this is not worth $500,000. This is only worth $450,000. Understand you can still a house. An appraisal doesn't dictate whether or not you can buy it. It just dictates how much the bank is going to lend you. And so if it only appraised for $450,000, they're going to give you 80% of $450,000. So $450,000 appraisal times 80%, or I guess in this case, 90% if we're doing that. So they would let you borrow $405,000, which means you've got to come up with the other $95,000 out of pocket. So not be your traditional, 10% down payment. You're putting down more because they're only giving you the percentage of the appraised value. And this is where we saw some issues over the past couple of years with house prices going up and appraisals not being quite there yet. When it doesn't appraise, you have to bring more money. You can still buy it under most cases. It's just more money out of your pocket. Does that make sense for everybody? So anytime you see loan to value ratio, it is just a percentage of price in most contexts, but obviously if it appraised for less, it would be a percentage of the appraised value. It is whichever is lower. This says lenders do not generally lend 100% of the value on a property. That's true. It is very rare, but there is specific loan types that do lend 100%. VA loans and USDA loans, meaning you can borrow up to 100% of the purchase price with those two types of loans. One other thing to point out, and it's going to come up in the slides in just a second. In that scenario where I said you were doing like a 90% conventional, like 90% LTV, and you're only putting a 10% down payment, if you've got less than 20% down on your home, you are typically required to have what's called mortgage insurance, sometimes called PMI, private mortgage insurance. So there's two different types. If you're doing a conventional loan, it is PMI, because conventional loans are private loans made by the bank and the bank bears all risk. If you're doing an FHA are government-backed loans, and so we just call it mortgage insurance because it is subsidized by the government. But let me make sure you understand this word mortgage insurance. When you're talking about homeowners insurance, that's called hazard insurance. And we have a brief chapter on insurance, right? Hazard insurance protects your home if it burns down, if it gets destroyed, if it does this, if it does that. Mortgage insurance has nothing to do with your physical house. It has to do with protecting the banks if you default, because you are considered a greater risk if you have less than 20% down payment. And so it is just a type of insurance that helps cover the spread between the equity you do have and the 20% the banks like to see. Doesn't cover you in any way, shape, or form. It covers. So if you've got this mortgage insurance and you default, this insurance company is going to basically just pay the bank a chunk to kind of mitigate, that 20% down payment that you didn't have. And I'm going to give you some examples of this in just a second, but I'll tell you what, mortgage insurance and that 20% number, very testable. Make sure you know those, okay? Mortgage insurance, very, very common when you have less than 20% down payment. because you're considered a higher risk. So this is where these T-bars kind of make a resurgence. And I told you they show up for all math, but while I showed you some of this with different math things like the commissions, the concept still holds true. If we were dealing with the loan to value ratio, the way that I just did it, right? If you were buying a house for $400,000 and you were getting an 80% loan to value ratio, I'm pulling up my calculator again to show you this, because if you like T-bars, you do you, boo. But I'm just showing you $400,000 times 80%, your loan amount of $320,000. All the T-bar is a visual representation of working the problem backwards. So in other words, if we said that you borrowed $320,000 and your purchase price was $400,000, meaning you only have one piece, all you would do is divide to get the other. And that's what this is showing you. Because remember, when you're going down the T-bar, you divide. If you're going across, you multiply. So in other words, $320,000 divided by $400,000 gives us 80%. That's all this is, a visual representation of this, how to work the problem backwards. If you can go front ways, you can go backwards. And so if you're looking at this T-bar, it's that easy. But remember what I showed you. If you ever have that missing variable, all you have to do is put a value, like just put a missing variable there. And then all you have to do is exactly what you would do normally. Get it on one side. Articulate this, just sounds less scary than algebra. If you had that one missing piece, all you have to do is the same thing to one side as the other. And so if you divided by 0.8 on this side, divided by 0.8 on this side, right? It works the same way. It's just some people are scared of basic algebra. I know, it's terrifying. And that's where the T-bars come into play. So the T-bars are just placeholders to help you remember how this works. But if all you've got to do is just throw in one little letter and then work it out that way. Is that like current interest rates right now, Douglas? Is that what that is? Yeah. 6.5.
That's where I got my first house with 100%.
Oh, Siku.
Yeah.
Yep. Same employees. They have 100% financing programs. That's exactly right. And they're privatized programs because they're a credit union. And so they offer that. That's exactly right. Those aren't bad interest rates for that either. I mean, for right now, anyway. So
Yeah, I
this
got
is
like
just
2.9%, I think now.
yeah, you got it when it was good. That's
When it was good, yeah.
yeah, that 2.9 is killer. Absolutely. That's the way to do it. Yeah. One of my students in post licensing is buying right now. She's about to lock her rate at like 6.99. So it's like, ugh. Yeah, it's rough. So this is just showing you, right? Home is being purchased for $425,000. Buyers obtaining an 80%, loan to value mortgage loan at 5%. What is the loan amount? Understand you don't need to do anything with the interest rate in a question like this. The biggest thing that's going to screw you up with all of these math style questions and financing is you're going to want to use a number that you're not supposed to use. That interest rate, ignore it, because all we're trying to figure out is the loan amount. Catherine, you got 2.5. Yeah, that's phenomenal, right? A lot of people, I mean, just really took advantage of that, and it was smart. That was, yeah. I wish I would have been able to, but seeing as how I have two houses, they probably were not going, it was going to take a lot of paperwork. So like mine's at like 4. And so I could have refinanced for like 2.5, but the amount of paperwork that I would have had to jump through and like, I couldn't, it would have been a nightmare. So I didn't. And now I'm regretting it because it's gonna be a while till they go down. Before is not terrible. I can live with it for a while. So if you're looking at these, right, all you're doing is just taking your purchase price times your loan to value ratio. That is it. 425,000 times, and remember too, if you don't like decimals, the calculator can do it for you. 80%. $340,000. That would be your loan amount. Means the rest of it, understand, anytime that's your loan amount, the rest of it is your payment. The rest of it's your down payment. So the crazy thing here is I'm having trouble like talking to you because I have like no room on this desk in the hotel. And so I'm like having to do this head bob because my microphone is so big, it's like taking up my screen view. I'm like, dang it, I need a different place to put it. Maybe it'll go here. There we go. We'll let that happen. That seems better. I don't know, now it's like too much on the screen, and it'll be all right. Forget it. Just put it back where it was. Screw it. I'll just do the head bob today. It'll be fine. This is fine. As LTV goes up, down payment goes down. In other words, if you've got a 50% loan amount, that means you've got a 50% down payment. If you've got a 90% loan amount, you've got a 10% down payment. So kind of like offsets. If you've got a 100% loan amount, you've got a 0% down payment. And so that's exactly how it works. Is if you've got more of one, you've got less of the other, and vice versa. That's how math works. So when you're dealing with an 80% loan to value ratio, putting a 20% down payment. If you deal with a 90%, you're putting a 10% down payment, so on and so forth. Nothing too crazy there. Well, let's talk about equity for a second. Equity is kind of an important word in real estate for a couple of different reasons. So let me explain. Equity is the difference between what you could sell for and what you owe. So if you could sell for $400,000 and you owe $200,000, you have $200,000 in equity. So what equity means, difference between what you could sell for and what you owe. So if you ever heard say, like I've got, $200,000 in equity, $150,000 in equity, that's not tangible cash, but it's money they could have if they sold their property. Just like if you ever hear people talk about Jeff Bezos or, some of these rich people, their net worth, folks, being worth $6.3 billion doesn't mean you have $6.3 billion in cash. That is what we call your net worth. In other words, if you sold everything you owned and paid off all your debt, that's what you would be left with, but you would have to sell it all to actually get it. And so equity is what makes a lot of these billionaires worth what they're, worth, because they've got investments that are worth something. If they sold them, this is what it would be worth. Same thing for your house. Now, when we're dealing with equity, there are three ways, and you do need to know these, three ways that you can grow your equity. Okay. The best way, meaning that you don't have to do anything, so everybody likes this way, is what we call appreciation. This is what we saw in the market over the past couple of years. People were willing to pay more for houses. And so if you bought your house for $300,000, but now somebody was willing to pay $500,000, your equity has increased and you did nothing. Okay, that's called appreciation. The other way that you can gain equity is obviously debt service, loan pay down. That's what we call debt service. If you borrowed $300,000 and you could sell for $500,000, but then over 30 years of paying off your loan, you no longer owe that $300,000. You now have $500,000 in equity. Every time the amount you owe the bank goes down, your equity goes up. And then the last way that you can increase equity, think of house flippers. It's called capital improvements. Not just painting a house or, making it look pretty, but actually renovating it and making it more valuable. That would gain your equity. So if you buy a house for $2,000, but put in $50,000 worth of work and now make it worth $400,000, that'd be capital improvements, gaining you equity. So appreciation, loan pay down, and capital improvements all can increase equity. And remember, equity is just difference between what you could sell for and what you owe. So let's talk about the reason why it kind of works the way that it does. When you're buying a house, there are two main factors that the banks look at for the borrower. One is your income and your debt, and we call that your income ratio. The other is your credit score. And so your credit score is utilized for basic loan approval, and it's also utilized for different interest rates, right? You get a better interest rate if you got a better credit score. But debt to income ratio is what's going to figure out how much house you can afford. That's it. Your credit score does not have anything to do with how much house you can afford. It's how much you make versus how much you owe. All that's your debt to income ratio. And the way that they look at this, and here's where it's kind of crazy. We're going to talk about this in this class, and there's going to be some numbers associated with this in some context, but I'll be the first one to tell you, in the real world, we are not trying to finance anybody. That's a lender's job. As a real estate broker, we need you to talk to a lender and get a pre-approval to tell us that you can buy a house. We should not actually be qualifying you in the real world. That's not a place to do that, contrary to what this class sometimes thinks. So when we're dealing with debt to income ratios, there's different percentages or ratios depending on your loan type. And the most common for conventional is what we call the 28 and 36% rule. Let's see if it's on the next slide. Otherwise, I'll just start talking about it. Not quite. I'm going to talk about it real quick. 28 and 36%. Let me show you this. When we're dealing with these ratios, I want you to understand that these rules, you can't break either of them. So for conventional, we call the 28 and 36% rule. And so it's based off of your gross monthly income. So if you make $6,000 a month, here's what these rules state. Your total housing expense cannot exceed 28% of your gross monthly income. And the 36% rule says your total recurring debts, including housing expense, cannot exceed 36% of your gross monthly income. So in other words, if you made $6,000 a month, under the 28% rule, you just multiply it by 28%, your housing expense cannot exceed $1,680. So if you were trying to buy a house that would have a housing expense greater than that, they're going to say, no, Slick, you can't buy this. And then the 36% rule, I'll just make sure you understand this, $6,000 times 36%, saying that your total recurring debt, including housing expenses, cannot exceed $2,160. Well, folks, here's the thing. Most people have some recurring debt. And so if you've got a $400 car payment, subtract that out. If you've got a $200 a month credit card payment, subtract that out. And that'll tell you how much is left to go towards your housing expense, because all of it can exceed this. So 2160 minus 400 minus 200. Because of those debts, the most housing expense you could qualify for is 1560. And I told you we can't break either rule. So the bank is going to give you the more restrictive of the two. So I'm going to say, well, because you have these recurring debts, you can only qualify for a housing expense of 1560. Because if they were to give you that much money, they would break this rule, and we can't break either rule. Does that make sense? They're always going to give you the more restrictive of the two. And let me explain why, just so you understand. And folks understand too, if you've ever heard somebody say something like, well, you know, I had to pay my car off, and then I was able to get the house I wanted. It's not because of, you know, anything else other than your debt to income ratio. Because if you've got a $400 a month car payment, but then you pay that car off, Well, now you can afford the 1680 house, right? Because if you add that 400 back in, right, you get rid of that car payment. So now instead of that, it's 2160 minus 200, which will give you 90. So once again, it shifted. Now they would let you have a housing expense up to 1680, because if they gave you that much, they would have broken that rule. And so that's why sometimes you have to pay stuff off in order to be able to buy a house, because it changes your debt to income ratio. Now let me explain why they look at both numbers. Folks, if you were one of the lucky people that had no recurring debt, in theory, they would give you $2,160 worth of housing expense a month. But here's the thing. How long are mortgages typically for?
30 years conventions.
30 years. Folks, what are the odds that in 30 years you will never have another car payment, that you'll never have alimony, that you'll never have child support, that you'll never have credit card debt, that you'll never have anything else? Slim to bum kiss, right? And so the banks aren't just going to let you have the higher end. That's why these ratios is checks and balances. They're always going to only give you the more restrictive of the two. So they can't break either rule. And I'm sure that'll come back up a little bit more in a second on the slides. I just wanted to go ahead and talk about it. Like I said, sometimes I think these slides just take too long to get where they need to go. So I'd like to introduce the concepts at the time. Now, when I'm talking about housing expense, understand that it includes things other than your pity payment as well. Your pity payment, which we talked about last week, that principal, interest, taxes, and insurance is your most common and sometimes your only housing expense. But if you had HOA dues monthly, those would fall into that housing expense as well. It doesn't include things like utilities. Please don't get confused. We're not talking about like your electricity or, you know, your water bill or anything like that. Housing expenses, your pity payment plus HOA dues, if they're, or, you know, whatever, you know, look like monthly, even if it's annually. So that does fall into housing expense as well. So when we're dealing with borrowing money, okay, there's some financing concepts that you need to be aware of, and these are kind of important as well. The banks, we've already said, are in the business of making money, and so they want to make money off of you in every way they can. Well, yeah, they're going to get interest off you over the life of the loan, but they would charge you some at the beginning. And so they have these two fees. They've got loan origination fees and discount points. And like loan origination fees imply their fees for originating the loan. Well, let me talk about discount points for a second, especially because if any of you decide to buy a house, somebody may talk you into this, and you've got to be very careful with discount points. Discount points is the bank giving you the option to buy down your interest rate. And so if you were sitting at like a 6.9 or a 7 right now, you could give the bank a chunk of money to potentially buy it down to a lower rate. But the problem with that is you're literally just giving them interest up front. So let's talk about the math of the discount point. A discount point is 1% of the loan amount. And I want to make sure you heard me. 1% of the loan amount. You've got to be very careful when you're taking any tests with this. All loan stuff can only be charged off of the loan amount. They cannot charge you fees on money that you didn't borrow. So if you had a $320,000 loan amount and you were purchasing one discount point, it would just be times 1%. It'd be $3,200 for one discount point. If you had a $320,000 loan amount and you were purchasing 6 discount points, it would be 6%. So times 0.06, $19,200. Now, let me tell you the crazy thing about discount points. It is what we call prepaid interest. You are prepaying interest to the banks for them to lower your interest rate that your loan has. And the problem with that is you buy one discount point, it only moves your interest rate down by 1/8 of a percent. 1/8. So in other words, if you wanted to move from a 7% interest rate to a 6% interest rate, you would have to buy 8 discount points. So if we were dealing with $320,000 loan amount again, was 0.08, it would cost you $25,600 to move from a 7 to a 6. 1 point is 1% of the loan amount, and 1 point moves the interest rate by 1/8 of a percent. So if you wanted to move it from a 7 to a 6.75, how many points would you have to buy?
Three
2.
points.
2 points. Because if you get technical, right, when you look at this, 1/4% is 2 points because each point is actually 0.125 of a percent. And if you think about it, it is 0.125 the way that it works because of it, it's 1/8 of a percent. So, that's what 1/8 looks like. So if you wanted to move it 1/4%, you'd have to buy 2 points. If you want to move it 0.5%, you'd have to buy 4 points. If you want to move it 0.75%, you'd have to buy 6 points. And if you want to move it 1%, you have to buy 8 points. And it is 1%. What you got, Claire?
So when lenders, you see them advertising this all the time, and they mostly sell they sell the loan within the first couple months. So really, this is really good for them because they're getting that interest up front.
Oh, it's excellent for them.
So it seems kind of like, as a buyer, I would never want to do it.
Here's the thing. If you plan on getting in that house and never moving, it could be a very good idea. But if you plan on selling or refinancing within 10 years, don't you dare, right? It doesn't make any sense because think about it. If you look at, I don't know, like 1%, like we just said, if you had $320,000 times 8, so 1% moving from a 7 to a 6 would cost you $25,600. Well, if you saved, I don't know, even $200 a month, that's a lot. If you save $200 a month in interest, all you have to do is figure out how many months it would take you to pay that off. So divided by 200, be 128 months before you got that back. Divided by 12. It would take you 10.67 years to make your money back. So if you plan on refinancing in, 5 years or less, don't you dare.
Right.
Because you will not have seen your money back. But if you plan on being there for 30 years, you will see a huge investment.
And if you're a realtor and you have, close relationships with a few local lenders that you always recommend, like I see them getting coffee all the time in the town I live in. What I would want to, is this our realm? Are we able to say like, hey, I know so-and-so told you the buy down points, but like I wouldn't, or is that kind of not our lane?
No, you absolutely can. I mean, you can explain it to the extent of, helping them understand how the points exist and why. And for some people, it makes sense. I'll tell you one thing that's happening right now, Claire, because interest rates are a lot higher and the inventory has been sitting on the market longer. Sellers have been offering to buy the rate down for the buyers. But once again, though, I mean, considering how expensive it is, I mean, the questions you always have to ask, because sometimes it's a good idea. The questions you always have to ask is how much is it going to cost to buy it down? What is it going to buy down the rate to? And how much is that going to save them each month? And all you got to do is math, right? Like I just did. If it saves them $150 each month, how long would they have to be there to make that money back? And if they don't plan on being there that long, don't let them buy it. Because to pay $10,000, $20,000 up front, I mean, that's astronomically large monies of just interest to the bank. So that is discount points. And so this is going on with what we've been saying, right? Some people decide that advantageous in some way, shape, or form to have discount points. And if you're going to be there for 30 years, it's possible that is a good idea. But if you're not going to be there for a very long time, it's possible that it's not a good idea in any way, shape, or form. But it does potentially lower your monthly payment. And if the seller's paying for it, it may be advantageous. So this is what we were just talking about. Why not to buy them, right? Why wouldn't you? Because sometimes just aren't worth the benefit they're providing for the costs, right? If you're not going to be there for a long period of time, it can be a huge waste of money. So here's the thing. I don't think at this point that they're still utilizing any of the closing disclosure concepts, but it's always better to go over it just in case. And so here's what I mean. When we're dealing with what we call a closing disclosure, we're going to talk about that some more in just a little bit. A closing disclosure is a type of settlement statement. And when we're dealing with settlement statements, meaning the day of closing, all monies associated with closing show up on the settlement statement, and everything is either, have we already talked about, because everything runs together, and I need y'all to help me out here. Have we talked about credits and debits already? We have. And we did the net to seller math already, yes? Good. So this makes a lot more sense. So we've already gone into this. So when we were dealing with that, we were talking about how much a seller was getting because we took all of their credits, all of their debits, and that was the net to seller. And then we also did that math where we said, well, how much would we have to sell for in order for them to net a certain amount of money? Well, when we're dealing with a buyer, we do talk about the buyer's credits and debits as well, because the difference between all the buyer's credits and all the buyer's debits is what we call cash to close. And so discount points are a buyer debit. They're paying it, right? Remember, debits means you're paying money, credits means you're getting money. And so they're paying the lender these discount points, whatever they are. And on the settlement statement, they show up as prepaid interest. So this last note says, discount points raise the lender's yield while lowering the borrower's interest rate because they're getting interest up front that they normally wouldn't have gotten for a while. And so they're getting a big old chunk up front. That's what it is. It's prepaid interest. Then they normally would have had to wait for. Discount points. 1% of the loan amount is how much a discount point costs, and it moves the interest rate 1/8 of a percent. Now, please be aware that if we ever give you any math questions that deal with like a closing disclosure and it's talking about discount points and the interest rates, we're not going to ask you to move the interest rate on like a big math problem like that. So like a lot of people think that like, it says you're getting a 5% interest rate and you're getting 3 discount points. A lot of people always think like, oh, I need to lower the discount points or the interest rate because of the discount points. No, you don't. We've already included that in a closing disclosure math problem. We would have to specifically ask you about the discount point math. In other words, what would, how many points would it cost to move it from a 6% or 7% or whatever? It's going to be we're not going to try to trick you in like a big math problem with discount points and an interest rate. I promise we're not. So this is just the math with it again. Now, do be aware that you've got to be very careful with the verbiage because there will be times where you've got a math problem that says, such and such is purchasing this home for $800,000, the assessed value is $700,000 and the loan amount is, $600,000. It's based off of the loan amount, right? That's what we can charge you interest off of. We can't charge you interest off of money you didn't borrow. So you always have to make sure that it is the loan amount. Okay, so it's just 1% of the loan amount for 1 discount point. If it's 2 points, it's 2%. If it's 3 points, it's 3%. If it's 8 points, it's 8%. So on and so forth. So here's another example. How much would be charged for discount points at closing to a borrower who is purchasing a $150,000 home with a 90% loan to value loan and purchasing 2 discount points? So this is a multi-step math problem. First, you need to find the loan amount. You're purchasing for 150,000 times 0.90%. You get your borrowed amount or your loan amount of 135,000, and then you're purchasing 2 discount points, which is loan amount times 2%, $2,700. Or you could do loan amount times 1 and then multiply by 2. Either way, pretty straightforward. Hopefully nothing crazy with discount points. Just that 1/8% thing is like the hardest part, the kind of the craziest part of it. Otherwise, it's just percentages. So here's that visual, right? I told you it is 1/8% every single time you buy 1 point. And so this is just kind of showing you better visual. Oh man, it's not in here. That's lame. I get some other slides that have it as like a pizza, which, you know, I mean, this is fine. This is okay. But the pizza was a cool visual because it was cut into 8 pieces. And so it's basically, you would need 8 slices to make one whole percentage. So it was a good visual. If I can find it later, I'll show it to you. So the other thing that comes up a lot in the context, same thing with discount points, because it's another, right? These are what we call lender fees, lender costs. There is loan origination. Thank you. There it is. She just put it in the chat. That is the one I was looking for. And I don't know why it's not on these. Electronic hoarder is going to electronically hoard, and it's super beneficial. So there it is in the chat. An origination fee is exactly what it sounds like. Now, unlike discount points, there is no rhyme or reason to the interest rate, origination rate. They just charge you whatever the hell they want to charge you. And so let me talk about this for a second. When you're dealing with lending, we're going to talk about some lending legislation here in just a minute, about things like TILA, the Truth in Lending Act, and things like RESPA, the Real Estate Settlement Procedures Act, and how it kind of came about under the CFPB and the Dodd-Frank Act and all these things. But I want to make sure you understand before we even get into that legislation, there was a lot that was enacted from a financing point of view around 2009 after the market crash of 2007, 2008, 2009. And the reason was there was a whole lot of what we call subprime lending, meaning lending was happening given to people that shouldn't have been lended to, that were not well qualified, or did not have the ability to pay it back. And there was also issues with appraisals. But the real thing that came about from this legislation was not that you always get the best interest rate. That's not how this works. The real thing is there are certain things that they have to tell you about the cost of the loan. And so the benefit comes in shopping around. If you get 3 different lenders to give you 3 different loan estimates and you look at them side by side, you can look and see what your interest is. You can look and see what your loan origination is. And you can look and see if they're trying to charge you discount points. And so you can compare them and figure out which one costs you the less but gives you the most benefit back. And that's where the real benefit comes, because the CFPB didn't stop them from charging you more than what you qualify for. It just makes them disclose it to you so that way you can shop around. And so loan origination fees are one of the big things to look at, because some banks may charge you a very small, they're all going to charge you something, but some banks may charge you a small amount for the loan origination and others a big amount. And so it could be 1% for a loan origination. It could be 0.5%. It could be 2%. And so anytime you get a test question, it's just going to tell you a number, and you just, but let me make sure you understand something. If we were dealing with, a $300,000 loan amount, and we said that the loan origination fee was 0.5%. I want to make sure you understand that 0.5% is 0.005. And so if you're not comfortable with that, let the calculator do it for you. So $300,000 times 0.5%. See how that works? 0.005 for 0.5%. And so it'd be $1,500. So just be very careful, because if you get into, any of the math works and it's trying to charge you, 5% is very different than 0.5%. So just loan origination fees are just always percentages. They'll tell you exactly what it is. And it is always based off of loan amount as well. Always based off of loan amount. Remember, they give you money on things that you didn't borrow. So that's all the loan origination fee. It's just an upfront cost. They say, give me this because we gave you this loan. There's no specific amount. It's just always a percentage of the loan amount. Called loan origination fee. This would also be a buyer debit. Excuse me, a cost that the buyer has to pay. So a buyer debit. So if you look at a question, what would be the origination fee charged to a borrower who is purchasing a $515,000 home with an 85% loan to value ratio? The lender is charging a 1.5% origination. So yet again, multi-step math problem. Take your purchase price, multiply it by your loan to value ratio to get your loan amount of $437,750. And then you take your loan amount and multiply it by your 1%, which is 0.015. But once again, if you're not comfortable with that, let the calculator do it for you. 437,750 times 1.5%. What you got, Mary?
Hi, yeah, good morning, and you're doing a great job, by the way. And I just want to say that with me looking at like how they break down like your test results right here, and I'm looking at what I struggled with that stopped me from passing. It was like, I think I got a 149, excuse me, I got a 49 out of a 57 finances, and this section right here was the main sections that I struggled with. And I'm learning, like, I didn't know this before when I took the test, that, like you said, you take the 515,000, and then I'm writing this down because I'm like, okay, I'm gonna sign up after today to take the test because I feel like something just clicked. You know what I'm saying? I'm like, I'm gonna take it because I feel confident. I'm like, okay, I got enough where I know I need, I can do it now. This is the section. That's why I make sure I came today. But I didn't know that the whole time I was doing it wrong, and then I couldn't understand what I was doing. But the way that you explained it, I get it. And the 515,000 with 85% loan to value ratio, you get that, and then you take that answer, and then you multiply that by the origination and origination fee, then you get the answer. And it was a couple of those, just to let you guys know, they had, most of those in the finance section where it was still kind of like math, but I remember these questions, and I took I guess, because I was like, I don't remember because I didn't know what to do. So I was like guessing or whatever. And I needed every little point. When you're trying to make it and pass, every point matters. Let me tell you, every question matters. And now that I know this, it's like, okay, you know what? I know it now. I was off by a couple points the first time, and the second time I'm ready. I get it. I'm writing it down, and I'm gonna keep playing it in my head and keep talking about it. Even when we get off today, when me and my husband go out to eat, I'm gonna keep saying that to him while we're at the dinner table over and over
retain
again.
it. That's right.
Yeah, I'm like, this is what, so I feel great. I thank you, because I was like, what am I missing? But now it's like, okay, this is it. Because I did not know, I was like, I didn't remember none of this. And like right now, I used to chill, do the classes and, relax so I could be in a good space. But I feel great. Like this is what I was missing. I did not know this formula at all. I don't know why I didn't know it. Maybe I was in La zone when he was teaching it, but I don't know.
It happens to the best of us.
Yeah, with Travis. Yeah, I don't know what was going on, and he was moving. He's moved kind of fast, and I don't know, but I did not know. I didn't know it like this where you broke it down. So thank you.
Yeah, absolutely. Yeah, I love that, folks. Here's the thing. There's going to be a lot of problems that are what we call multi-step math problems. Same thing too with when we talked about the home measuring last, and I showed you about like the square footage. Those are like multi-step math problems as well, because if we've got, square footage, but we need acres, and then we're going to ask you what it would sell for if it was, sold for this much per acre. So a lot of multi-step math problems where you just have to take it step by step and get to where you need to be. And so remember, you can never charge interest or any other loan stuff off of purchase price, because you're not borrowing the full amount. You can only charge it off of the loan amount. To find your loan amount first, and then you can use that for interest and interest rates on general, because we're going to talk about interest rate math. Simple interest was what you call it. Loan origination fees and discount points. All of these things are based off of the loan amount. Be very careful, because I told you there's going to be sometimes three numbers: loan amount, purchase price, and assessed value. Could all be in the same question together, and you've got to know when to use what. Assessed value is only used for real property taxes. Purchase price, commissions, and excise tax. And loan amount is used for all the loan stuff. So very important to differentiate those numbers. We're going to talk about all those different things more in just a moment. So when we get into types of loans, also, I've never heard the WAG method. I like that. Wild ass guessing. I like it. That's a good method. Sometimes you got to use that WAG method, right? When you just look at something, you're like, I have no idea. B. That's right. So we're talking about types of loans. This is where we use this a lot in our day-to-day lives as real estate brokers. So yes, it's on the test, but this is also stuff that you will hear in the real world. This is not a comfy chair that I'm sitting on. My butt bone hurts. Ugh. Ugh. Not my normal chair. Depressing, right? It's kind of like, it's kind of bittersweet, because I'm like, man, I'm so uncomfortable. I'm also looking right at the crystal clear blue water right there. I mean, it's like right there. So I'm like, butt hurts, but the view's pretty good. That's exactly right. Let me know. You can see like the sun on my head yesterday. Man, I was like a kid yesterday. I put on goggles and a snorkel, and I was just out there swimming around looking at seashells, right? I was having a good old time. Sharika, today it's like 78. I think is what it is. Or the high is 78. It's been about, mid 70s the whole time. Not too bad. Although, the water has, it's got a little bit of a chill when you first get in, but it's not that bad. So let's talk about types of loans, okay? Because this is stuff that we're going to deal with in your careers, even after licensing, right? These are things that we need to know. And so when we're dealing with these different loan types, you'll hear us talk about conventional, USDA, FHA, VA, and they all kind of have their nuances. When we are talking about conventional mortgage loans, they are loans that are what you would call privatized more than anything. They are not backed by any government institution in any way. The lenders bear all the risks is another way of saying that. In a conventional loan, the lenders bear all the risks. And so conventional loans is just one option that exists out there. It is a very broad and prevalent loan program that a lot of people utilize. And so the most common conventional loan is a 20% down payment loan. In other words, 80% loan to value rate. And when you put down that magic number of 20%, that's what helps you avoid having to pay mortgage insurance. As long as you have at least 20% down, you typically don't have to pay mortgage insurance on a home. If you have anything less than 20% down, you typically do have to pay some type of mortgage insurance. And when you're dealing with conventional loans, because they're not backed by any government, excuse me, we call that mortgage insurance private mortgage insurance, PMI. So conventional, oops. I don't really, well, I don't really like this slide, and I'll tell you why, because you should really only be thinking of the word guarantee for VA loans more than anything. When we're dealing with government-backed loans, VA we call guaranteed loans, meaning if the buyer defaults, that Uncle Sam is just going to cut a check to the bank and buy the house. That's why it's called a guaranteed loan, right? It's called a guaranteed loan. When we're dealing with FHA and USDA loans, FHA are what we call government-backed loans. And so there's basically a type of insurance that is backed by the government, okay? So those are a little bit different. So I don't really want to I don't like that slide. I'm just gonna skip over it for that reason, because it's not the same thing as insurance. Because I want to make sure you understand this. The reason why I was emphasizing it, when you have mortgage insurance, all it is an insurance policy that you have to pay for that helps cover money for the bank if you default. In other words, let me show you this. If you purchase a $400,000 house with a 90% LTV, ooh, that's not a good place for that. Kind of gets washed away in there. 90% LTV. That means you are putting 10% down. Okay. So $400,000 times 90 means your loan amount is $360,000. And then your 10% will be the $40,000. There's a point to this, I promise. Well, folks, $40,000 is what you put down, but if this was a normal conventional loan, right, they like to see 20% down payment, which is $80,000. So here's what mortgage insurance does. If you have only that $40,000 down payment, but what they would like to have seen is $80,000, the mortgage insurance is a policy that they make you pay for that says if you default, that company will basically pay out the 40 grand to the bank to help them cover that gap of what they didn't have from you. That's it. It is not covering anything outside of that 20%. It is not buying the house. It is not like that. And so that's why I don't like that last slide, because mortgage insurance is not the same thing as a guarantee. There is no realm that the bank's getting all of their money. That mortgage insurance just helps that spread from whatever your down payment was to the 20%. Does that make sense? But a guarantee means if you were getting a VA loan, VA loans are guaranteed loans, and they're also 100% loan to value ratio. And so if you qualified for a $400,000 VA loan, you could borrow $400,000. And let me tell you how this guarantee works one more time. If you were able to get through your entitlement, a VA loan is a guaranteed loan. You buy a $400,000 house and you stop making your payments, you default. The VA is not the one lending the money. It's a bank that lends the money. And so when you default, the Department of Veteran Affairs will actually write a check to the bank for $400,000 and buy that house. And then the VA becomes the owner of the house. That is why insurance and a guarantee are very different, because the banks can foreclose on you in a conventional or any other type where it is just backed by some type of insurance. But in a VA guaranteed mortgage, the VA is just going to buy it, and then it's going to be their problem. They're going to have to turn around and sell it themselves. Does that make sense? And we'll expand on this some more, but insurance and a guarantee are not the same thing. So conventional mortgage loans, because they are considered higher risk, well, they're actually considered lower risk loans, but the lender bears all risks. The reason they're considered lower risk is because they're made to well-qualified buyers, right? They have higher expectations for interest rates. They have higher expectations for down payments, whereas some of these government-backed loans, I'm sorry, I said interest rates, I meant credit scores. They have a higher expectation credit score in a conventional loan, and they have higher expectations for down payments in a conventional loan versus some of these government-backed loans that are a little more lax, right? You can qualify for a little bit more in these government-backed ones, and we'll talk about that. So made to the most well-qualified buyers with best credit and highest down payments is typically how we do conventional. And I understand there are 100% financing conventional programs through special credit unions. There are also like 5%, 10%, 15%, but the most costs a 20% down payment, which is the one that avoids mortgage insurance. So this is where I told you it is a lower loan risk, even though the lender bears full risk because they're not backed by any type of government. They usually have, less risk for the lender because they've got more down payments involved with conventional. Most people are doing conventional or doing at least 10, 15, versus folks, just to put in perspective, USDA loans, you can get for no money down. VA loans, no money down. And FHA, your down payment is 3.5%. See the difference? 3.5% versus 20% is a huge difference. If you were looking at purchasing a $400,000 house with an FHA loan, it's a $14,000 down payment. You're purchasing a $400,000 house with a conventional, 80,000, right? That's a huge difference. So higher down payments on conventionals typically, which means lower loan to value ratios. Remember, the more down payment you have, the lower your loan to value ratio is. So if you pay 20% down, 30% down, 40% down, the remaining is your loan to value ratio. So 40% down payment would be a 60% loan to value ratio. Always based off of 100. And lender is more comfortable because the has skin in the game, right? Skin in the game. They've got money to lose. And the reason why this is important, folks, is if times get tough and you can't afford your mortgage payment anymore, the banks consider that if you don't have that much money in equity, that you're more likely to just walk away. And I can't stress this enough. The banks don't want your house. They want money. They're not in the business of houses. They're in the business of money. And so that's why they want you to have a lot of skin in the game at 20, 30, 40% down payment, meaning $100,000 or more in equity. You're not going to walk away from that house because that's a lot of money to lose. But if you've only put in like $7,000 on a house and hell, most of that was paid by the seller, you don't have a lot of skin in the game and you're more likely to walk away. So uninsured conventional loans, meaning ones that do not have to have, don't get this confused when we say meaning you don't have insurance on your house. Remember, hazard insurance, homeowners insurance, something completely different. If you've got 20% down on a conventional loan, it is what we call an uninsured conventional because you do not require mortgage insurance. But if you have anything less than 20% down, they typically require some type of mortgage insurance called private mortgage insurance because you have to go through a third-party private company because it's not backed by the government. So that magic number is highly testable on the state level test. 20% equity, I'm sorry, 20% down payment equity too. We'll talk more about that in a second, is what will help prevent you from having to put mortgage insurance premiums each month and annually, so on and so forth. That being said, I'm gonna be nice and give y'all a couple extra minutes. So go ahead and take a break. 10:30 to 10:40, and we'll come back and we'll keep on rocking and rolling. All right, folks. 10:40. Work your way back. Get your cameras back on. We'll keep this fun-filled day rolling.
Hey Seth, it's 49 degrees here.
49.
Mm-hmm.
That's kind of lame. That's what I heard. That it was like 81 day a couple days ago, and then it went to like 30. This is of like North Carolina, and I was in Georgia all last week, and it was, you know, really nice in Georgia, and then now I'm in Florida, and it's also really nice in Florida. So y'all can have that cold weather. I'm just, I don't know, bathing suits and palm trees, and you know, it's so hard.
Especially in an uncomfortable chair, right?
You know, yet again, first world problems, right? First world problems. That is like, my chair hurts at Panama City Beach. Me. That's what I told y'all last week, right? The other first world problems while I was in Georgia, I didn't have any of the Yetis, right? And so, I mean, I'm just full of first world problems because I'm like, oh, my coffee is cold at my second house because I don't have the Yeti. Yeah. So, yeah, legitimately first world problem.
Top life. Stinks. Real bad.
Yeah, that's exactly right. It's just rough.
Oh, and you were forced to stay in Florida for an extra day because of this class. So
because of class, that's exactly
the
right.
horror.
I know, the poor thing, right? Because the teaching, right? Like I had to like book the hotel for today because checkout time. There's no way I could have done this. But I'll tell you what, folks, we are screwed because tonight is time change. That's what I've been told. Y'all, somebody verify this, but that's what the people have been telling me. That Heather says yes. Tonight is spring forward. So that means at 2 o'clock, it's actually 3 o'clock. So you lose an hour of sleep tonight. You ready for the worst part of this? Panama City Beach is an hour behind. So I'm losing 2 hours tonight. Because it's only 43 right now. But basically when I drive back to Georgia and then make it back up to North Carolina, if I get there at midnight tonight, I actually got there at 2 o'clock in the morning because it's like 2 hours difference. The world's smallest violin, Christy, is that what it is?
Yes,
So-
no, wonk, wonk, wonk. No
You
know
kidding,
what?
I don't feel.
That's cold-blooded. So cold-blooded. Road. Yeah. Claire, you're absolutely go ahead, Georgia.
Becky, I got my book. And I just want you to know that it came faster than any Amazon shipment I've had all week.
I am so glad. I'm gonna get with Matt. The printer has allegedly sent our books, so I have to go nag them. And I had to call the printer, and I think I was telling Lydia about this. When I called and the guy heard my voice at the printing company, he sighed in a way I have not heard since my second ex-husband. Sighed. It was glorious.
What was the problem?
They were taking forever to print it when they have a policy internally, which we were not aware of on the Learn Test Pass end, that if it is going to a business, it gets priority printing. It's going to Matt's personal address now, not to a real estate office anymore. And so they're just kind of treating us like, hey, here's your hobby book that you're going to send to grandma for Christmas.
Oh,
I was a little about it, I guess, but I think I kind of ruined his day, and I feel both bad and kind of good, because shouldn't it be in the order that the orders are received? That's how I would do it. Like,
wouldn't that make sense?
like presenting offers to your client. You don't say, here's the good one and here's the crap. It's this one, this one, this one, this one, this one.
Yeah, do them all. That's exactly right. Yeah, that's kind of lame. How do they know? I mean, I guess, is it just based off the fact that it's Matt's name versus like the name of like an entity, or is it the actual address has to be like a corporate address versus, you see what I'm saying?
Yeah, it used to go to, Matt's changed firms.
Mhm.
And it used to go to Keller Williams, and now it's just going to his personal address because the firm address is also a residential address.
Mm.
And so they just kind of viewed it as Matthew Davies at blah, 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 instead of Matthew Davies, care of Keller Williams
Mm.
kind of thing. So.
Gotcha. Well, so hopefully, yeah, it's all taken care of now that, you made some guy's day in some way, shape, or form.
Made his day. Oh, that sigh. I felt so much power. I would invade a country. That's how much power I felt in that moment.
You had a full-fledged Napoleon complex going on, huh? You
I
just,
did,
you
and I
felt very, very big. Yep, that's right. I like it. I like it. Yes. So now that we've ruined everybody's day with the time, but the time springing forward, right? Only that guy's day was ruined. Yours was ruined because of the time springing forward tonight. And world's smallest violin for me because I'm leaving the meet. I lose 2 hours tonight. So woe is me. But I digress. Let's get back to these this loan stuff. Okay. 20% down, magic number to avoid mortgage insurance in a conventional loan. Becky and Pate's Royal Palm Press deserved it. So this is where I've been explaining this mortgage insurance to you. It says partially protects conventional lender in the event of a foreclosure. It doesn't protect them for the whole thing, right? That's what the foreclosure does. They sell your house to get their money. All this is doing is protecting a small piece of it to mitigate the fact that you didn't have 20% down, which is normally the most beneficial level of risk they like to take, because you got 20% down, which is why they don't require that mortgage insurance. Anything less than 20% down typically does require this private mortgage insurance. And understand the difference, right? You will hear the term mortgage insurance when we talk about FHA loans, but we just call it MI for mortgage insurance with FHA because it's government backed and government subsidized insurance. When it comes to conventional, because there's no government backing at all, we call it PMI, private mortgage insurance, because you're getting it through a private third party company as opposed to government subsidy in that sense. So private mortgage insurance. This is another one of those visuals that is, attempting to do something, but it's kind of a little confusing. In other words, if you are dealing, this is just talking about the loan to value ratios and how much equity you have versus, their risk. We don't need to look here. I've already explained it. I think that visual has too much going on. You are just considered a much higher risk if you've got a higher loan amount and a lower down payment. You're more likely to walk away. If it's 100% loan to value ratio, you're very likely to walk away because you've got zero skin in the game. So it is a much bigger risk in that regard. And this is what I've already said as well. The loan will not be fully insured. Only the riskiest portion will be insured. And so that's what we've been saying. Nothing crazy here. We're good on this. And that's also what I've already said. So we're good. Only the debt above the 80% is covered. In other words, to the insuring that point from what you have as a down payment to that 20% mark, which is all what I've been saying is already. So we're good. So let's talk about FHA loans. Now, here's the thing. I want you to understand that you will see the terminologies, and this is used in the real world between conventional, FHA, VA, USDA. And then talk about something else called the secondary mortgage market. And I just want you to be very careful with how the questions are worded. When we're dealing with an FHA loan, there's nothing too crazy about FHA in and of itself, except for a couple key points. But FHA stands for Federal Housing Administration. It is not the same thing, because remember when we talked about some of the advertising, we talked about the fair housing. Please don't confuse these. FHA is not the Fair Housing Act. FHA is the Federal Housing Administration. So this has to do with government insured, government backed loans that are put out and looked over by the HUD, right? The Federal Housing Administration, the Department of Housing and Urban Development, the HUD, basically backs these loans. And the reason that these exist, there's a whole lot of reasons, and there's plenty of videos out there, but I don't think you really need to know to that level. Basically, the way that home buying happened changed. Houses used to cost a quarter, and no, not really a quarter, but they used to be a lot cheaper than they are now. And then as things have increased and the way that the money and the Fed and everything has happened, they basically needed to make home buying more affordable. And so the federal government created these government-backed loans because the banks are investing money and bearing a lot of risk, and people couldn't afford houses. And so that's why these government-backed loans existed. And then we'll talk about the secondary mortgage market in just a second. When we're dealing with FHA, though, all it does is it is understand the banks still lend the money, but these have to meet what we call FHA underwriting guidelines. That means, the government says, if you build it like this, then we will back it like that. And so it helps banks dealing with what we would consider higher risk borrowers, people who are putting lower down payments, people who have less than perfect credit scores. But it is always the banks lending the money. It is just the government that's backing it to help take some of these risks away from the banks, because they wanted to make home ownership more available to a broader spectrum of the public. So FHA loans are arguably for anybody, although there are these are one of those things where you can't make too much money. Okay, they do have a lower credit score where you can have a lower credit score than a conventional under most circumstances. But if you make too much money, you may not qualify for an FHA loan. And the beautiful thing about FHA loans, I told you, there's what we call a 3.5% down payment on FHA loans. And they do have mortgage insurance, but it is just called mortgage insurance, not private mortgage insurance, because yet again, you have less than a 20% down payment because you're only 0.5% down. And the government is backing it. So we call it mortgage insurance versus private mortgage insurance. Basically, the insurance is subsidized by the government. And your first year mortgage insurance premium can actually be rolled into the loan for these FHA loans. And these are great loans. I think when I bought my first house, I think I bought mine with an FHA loan because 3.5% down, not bad.
So, I mean, are there any specific criteria in order to get eligible for FHA loans, Seth, apart from the credit score?
Not really. You just can't make too much money. But other than that, there's really no criteria. Anybody can arguably do an FHA loan.
Okay.
Yeah, you would just have to talk to your lender about FHA loan programs. Not all lenders lend FHA because remember, it's the banks that are deciding if they want to do this. But it's just they have to build them the way the government wants to see them because they are backed by the government. But as long as it offers it, you can ask them, and then they look at your information and say, "Do you qualify?" And it's like I said, it's available to anybody. But if you make too much money, they may say, "Nope, you make too much money to do a FHA."
So even these loans are offered by the private banks, but just the backing will be by the government. That's it.
Typically, the government doesn't do these for, non-federally insured depositories. And you probably like SECU, like Douglas was pointing out earlier, is a credit union. And so credit unions are not typically federally backed banks. And so they typically had their own loan programs to kind of compete with this. But it's most of the time you're only going to get these government backed loans through federally insured, public banks.
Thanks, Seth.
Mm-hmm.
For the mortgage insurance, so the conventional, it insures the debt above the 80% or up to, above the 80%.
Above. So like the difference between what your down payment is and the up to that 80%.
So with the 3.5% down, would the mortgage insurance just be on from 3.5 up to 20% or?
Yep.
Okay.
Yep, that's exactly right. It's still not covering the whole loan. It is only designed to cover that spread between the down payment and the 20% down payment, like what you actually put versus the 20%.
And is that something that's different for every mortgager or buyer, or is it a set percentage for mortgage insurance, or I don't know if that.
It is slightly different because of the amount of what you're borrowing, right? So it's a percentage based off of what your amount borrowed is. And so it is a percentage. There is no set percentage that I can tell you that it's always 0.5 or something like that. Typically the first year's premium is higher and then it goes down after 1 year, for renewal periods because you've got more skin in the game and you've been in there for a year, you're considered less of a risk, but there's no set like one size fits all percentage.
And that's not something you can shop around for as in home insurance or car insurance?
Not for FHA because it is backed by the government, but there's really no shopping around for it because everywhere's going to require it. They're not going to be too different where you're going to get like a better deal one place than the other for most instances. Yeah. So FHA is what we call FHA insured loans because that insurance is backed by the federal government, only requires 3.5% down payments, typically allows a slightly lower credit score as the threshold for getting into these FHA loans. So it is a fantastic loan program if you get one. Nothing too crazy about them. I will tell you this, FHA loans, the insurance never falls off. And so with like a conventional loan, a lot of times when you get like a 10% conventional and you pay it up to 20%, Typically, all you have to do is contact the company and say, hey, I've got 20% equity, you know, can you take off the mortgage insurance or private mortgage insurance? And they'll take it off. FHA, they'll never remove it. So you refinance in order to drop off your private mortgage insurance. And so when I'm saying like private mortgage insurance, understand that you would pay a premium for the full year at closing. And in some instances, it can be rolled into the loan for the first year. And then when I was talking about your PITI payment last year, principal, interest, taxes, and insurance, well, this would also fall into that insurance category of PITI. So you would have this built into your monthly PITI payment to make your premium payment for your insurance every month. And if you have like an FHA loan or any conventional loan with mortgage insurance on it, if you look at your monthly statement, you're actually paying mortgage insurance every month. Whereas the other escrow things you pay once a year, right? Like your taxes will go out once a year, your insurance, like your homeowner's insurance will go out once a year, but this goes out every single month if you've got this mortgage insurance. Other couple things to know, and I think when Sandeep was asking about the qualifications, because of the nature of these were designed for families. These are only intended for owner occupied properties. You have to be living there. You cannot use an FHA loan as a purely investment property. However, you can use an FHA loan for up to a quadruplex because that's still considered residential. As long as you're going to move in there into one of the units, you could use an FHA loan to purchase a duplex, triplex, or quadruplex, as long as you're living in there. If you purchase one solely for an investment with an FHA loan, that's called loan fraud, which has severe penalties up to fines of $1 million and jail time. So you're not allowed to do that. But understand that once you've met certain criteria, it can be converted to an investment property. You just can't buy it as an investment property. Typically, if you've been in there, you know, a certain number of years, or if you can prove that you had to move for like job or relocation or something like that, they'll typically allow you to turn it into an investor property, but you can't purchase it as. Most of these are typically 30 years, just like any other loan type, conventional or otherwise. Go ahead.
How long do you typically have to live in the property? If you were-
I think the general guideline, I can't remember, if it's 1 to 3 years is the norm. But once again, if you can prove that you had to move for like work or something, I think it's like you don't have to be there any period of time past like 3 months, but there's like a burden. So you would make sure you call your lender, because I can't give you a definitive thing, but it's typically 1 to 3 years before they're like, yep, do whatever you want with it, unless you can prove that you relocated. Yep. I also don't have a table. I have no table space. I'm like reaching on the floor for my coffee. A couple things to note about this FHA loan. Remember, it's the banks that are lending the money, not the Federal Housing Administration, okay? So the interest rates are set by the lender, not the government. Remember, it is a government-backed loan, so it cannot contain a prepayment penalty, and it cannot contain an alienation clause. In other words, it's assumable. These government-backed loans are always assumable. The interesting thing about these, as you can imagine, if the government's got some skin in the game, like they maintain some level of liability, the biggest thing about FHA and VA loans is they have very special appraisals where they are evaluating the property because they want to mitigate their risks. They do not want to backing a loan on a house that's, as I like to say, a turn on a stick. And so they will have requirements for certain repairs to be done, and sometimes they're strict, right? I mean, if you've got like a shaky handrail on like your back deck, they're like, nope, fix that. That's a liability. It's a danger. If you've got, even something like missing carpeting, if you've like ripped out the carpeting and it's just exposed floor, they don't like that. So there's a lot of things that they are very particular on, where they'll say, well, this needs to be fixed before we fund this, because they are backed by the government. The government wants to make sure that, they're a little more, they evaluate a little bit more than the banks do in and of themselves. We'll say that. So there are appraisals for conventional loans, but when we get into VA and FHA appraisals, they are more thorough. They are more specific. They almost, get into the territory of doing a little bit of a home inspection as well, because they're looking for flaws like that.
All right, this is my last question, I promise. If-
Unacceptable.
For these government loans and they have special appraisals, I've heard before that if the appraisal comes back and it scares the buyer, that appraisal sticks with the house. With government appraisals, is that like a material fact, or is that doesn't matter? Or
Yeah, it arguably would be. And so they sit with it for a period of time, and that's beyond the scope. I think it's either 3 months or 6 months that it sits with it, because they are government-backed loans. If somebody else, come and try to buy the property, that appraisal is going to stick with the house. And so they're not going to, because once again, the government doesn't want you to be able to just go through a new appraisal and somebody, say it's worth more, and then they get screwed monetarily speaking and backing this loan. And so it does stick with it for a period of time, not forever. And like I said, it's no more than 6 months. Yeah. And it would be a material fact. This is not something that I think you're going to see anything about on the test, but just for your own purposes, you will probably hear about the 203B, the most common type of FHA, single family home loan for the 203B. They do have about 20 different ones. There is, 203Ks, 203Hs. And so that depends. There is a special one for a condominium because you cannot use B for a condo, but they do have one for condos, FHA backed. They also have what they call a rehabilitation loan. So you can get I think that one's the 203K. And basically what it allows you to do is get the purchase price of the home, plus they give you a chunk of money to do the rehab if you can show that the rehab value is up to a certain point, right? So that one's very rare, but it is something that exists. But 203B is the most common. Nothing too crazy for you to remember there. We've already said this. FHA loan is not fully insured. It's just a type of insurance that helps with some of the risk associated with the default. Typically that difference between your 3.5% and your 20% down payment. It is not a loan. That's why the banks foreclose. They want to sell the home to make their money, because if you default, this insurance policy is not paying the full amount in any way, shape, or form. They're just partially insured to help mitigate the risk. That's all.
That means the FHA loans are typically equivalent to the conventional loans. Only the difference is instead of the private mortgage insurance, there is a special kind of insurance which is backed by the government, and it is at the affordable cost. Am I correct, Seth?
Yes. Also, here's the thing. There's no absolutes in real estate. And so yet again, most conventional loans will not allow you to go down to a 3.5% down payment either. And so this is where is one of the lowest down payments that you can possibly see with 3.5%. But yeah, I mean, that in a nutshell, that's it. Because if you have less than 20% on the conventional, the lender bears all risks. To have mortgage insurance. You get an FHA loan, the lender's not bearing all the risks, the government's taking some of it, and you're still having to pay for this insurance just through this government program, and you typically have slightly lower credit scores that are allowed for this. So not a huge difference. From a real world point of view, the other big difference from the real world point of view and testable, conventional loans, the mortgage insurance will fall off when you hit 20%. FHA loans, even when you hit 20% equity, it still doesn't fall off. It stays on it forever until they answer do something else.
So the government is bearing the burden only for, is taking the risk for risk protection for that 16.5%. That's the only thing that they will be in the picture. And once the the borrower hits 20%, the government will move off from the picture. How does that work?
Well, that's what it's designed to do, right? That is what the mortgage insurance is designed to do. Understand the borrower is still paying the mortgage insurance premium. The government's not paying it. It's just a little bit more affordable versus private mortgage insurance because it's subsidized by the government, but the borrower is still paying that insurance, and the insurance is intended to help in case of a default to cover some of the costs up to that 20% for the lender. But understand that nothing changes even when you have 20% equity in an FHA. You still keep paying that premium. And what happens if you default? Knows, right? Because at that point, is the insurance going to pay out anything to the lender? Probably not, because you've got over 20% equity at that point. But just understand that you're going to keep paying that payment even though you've got more than 20% equity. So it may be advantageous to refinance in a conventional loan at that point.
Oh, okay. Okay, we can do that, like convert from FHA to conventional loan at
Well,
least
with a
20.
refi, so it's not really converting. When you refi, folks, all a refinance is, if you've ever heard this terminology, is you get a new. So if you, let's say, purchased your home for, let me put some low number, $250,000 with FHA, and you put a, I don't know, well, don't even worry about the down payment. After 10 years, let's say that you paid this down to $200,000 is what you owe the bank still. You're still paying that mortgage insurance premium. And so what a refinance is you go to another bank and say, can I borrow $200,000? So the new bank will lend you $200,000 and you'll pay off the old one. So your FHA loan is gone and your new $200,000 conventional loan with no mortgage insurance is what you're now paying at a new interest rate. That's all a refinance is. A lot of people don't even use the same bank. It's just getting a loan from a bank to pay off your current loan because you like the terms of the new loan better. So a lot of people will do this. They'll get an FHA loan to start, and through appreciation, right? If your house appreciates like $50,000 more than what you bought it for in 3 years, you may just turn around and refinance it in 3 years and, have a conventional loan because of all the equity you have in the house.
Okay.
And pay no PMI. So VA loans are kind of interesting. Okay. When we say VA, that is short for the Department of Veteran Affairs. VA loans are only available to veterans, active, retired, and their spouses. That's it. It is not available to anybody who has never served in the military, unless you are married to, you are a spouse, and you could be a widowed spouse and still be entitled to it. But it's not for anybody in the public. Okay. It is for veterans and families only. Now, I want to make sure that you understand. I'm just going to skip on over this. I just want to talk about this for a second. Okay. When you're dealing with a VA loan, they are typically 100% loan to value ratio. So if you're purchasing a $300,000 house, they would lend you $300,000. And so there is no down payment required in any way, shape, or form, as long as, you've got the guarantee from the government. But let me just talk about a couple of things. If the house doesn't appraise for what it's supposed to appraise for, what you're going to buy it at, it's what we call a CRV, a certificate of reasonable value. And that is something that you will probably see on the test. CRV, certificate of reasonable value in regard to a VA loan. If the appraiser, the special VA appraiser, does not determine that the house is worth what you're going to purchase it for, can still purchase it. But just like that, it's always a loan to value ratio. They're only going to lend you the appraised amount. So if you agree to buy it for $300,000 and the CRV is $295, you will have to put that $5,000 down yourself, because the lender, God, why can't I think of the words? I can't talk today. The VA is going to guarantee the amount that it's actually worth, correct? Because these percentages are always debt loan to value ratios. But let me explain the other piece of this. These are called guaranteed because what happens is you have a level of entitlement, and your entitlement is based off of your length of service. So your entitlement can be anywhere from a couple $100,000 to $1 million. I mean, it can be up there depending on how long you've been with, whatever military branch you're in. But please don't mistake this for the government just giving them money. They're not. They are guaranteeing the loan. you have to actually make enough money to qualify for a $300,000 loan, a $400,000 loan. It has nothing to do with, oh, they're so lucky the government's just giving the money. They're not. You still have to qualify. So just, you may have entitlement up to $600,000. If you're not making a lot, you may not be able to get a loan for more than $200,000. You may only have entitlement up to $300,000, but if you're making a lot, you could get a loan for $1 million. But understand that if you don't have entitlement up to that $1 million, you're not getting a VA loan, because what the hell's the point if the government's not going to guarantee the full amount? So let me paint the picture here. If you qualify for a $400,000 purchase with a VA loan, and your entitlement guarantees $400,000, then you are going to get a VA loan, and they will borrow the full $400,000. And the reason why this is called a guaranteed loan is because if you default as the veteran who purchased with a VA loan, Uncle Sam literally just writes a check to the bank to pay off the rest, and then they get the ownership of the house. It doesn't go through the foreclosure process. The Department of Veteran Affairs just takes the house, and then it's their problem. That's why we call it a guarantee, because the aren't ever going to end up with a house as long as the VA and, you know, everything is done right. And so I've actually helped clients purchase houses for the Department of Veteran Affairs before, because what they do is they just turn around, hire a real estate agent, and then they sell them themselves to get their money back. And that's kind of the perk for the veteran. If you default, you don't have a foreclosure, but you will never get a VA loan again. If you default, you lose your entitlement. It's gone. So they basically say, thanks for your service, get the hell out of the foreclosure, but you can't have a VA loan ever again. So you can lose your entitlement by doing things like that. Understand too, that when we're dealing with this entitlement, you know, you get your entitlement back every time you pay off a loan. So if you've got $800,000 in entitlement tied up into an $800,000 house, but then you pay off that house, you've got $800,000 entitlement that you can use on the next house. And you can use VA loans for life, as long as you get your entitlement back. The easy thing about VA loans is they're also assumable, because they're a government-backed loan. And they're assumable by people who are not veterans. So if a veteran purchased a home and had a VA loan and wanted to allow a non-veteran to assume their loan, they could. But their entitlement would be tied up into that VA loan and that home, and they would not get it back until that home was sold again or it was paid off. So it is an idea for a veteran to ever allow anybody to assume the loan, but it is possible. What you got, Heather?
It's probably not in the scope of this, but just as a curious question, like, because I got a VA loan, I'm a veteran, and I didn't know about this entitlement thing. Like, where do you get that number from? Is that?
If they lent it to you, then your entitlement covers it. We'll just say that. So, I mean, you would have to call the Department of Veteran Affairs to ask like how much entitlement you have.
And can you use a VA loan? Can you have multiple VA loans at one time, or just one?
If your entitlement covers that much and you make enough money to qualify for both, you can.
Huh, good to know.
What you got, Douglas? Oh, can't hear you. I think your microphone might be.
Sorry, I accidentally hit
Yeah.
that. I'm sorry.
You're good. Oh, were you saying something?
Oh, no, I was just kind of backing. Yeah, you could have multiple properties if you, like, I got a friend that's been in for 30 years. He retired as a senior chief, so he has multiple places. So depends on your time you put in, how much, you know, it's the more time you have in, the better, the more you will have. And it also depends on how much money you make as well.
Yep, that's exactly right. So on that note, Heather, I've got some friends of mine who are married spouses that were both military, and they've owned 3 properties at one time using, you know, both of their VA loans because they had that much entitlement between them. And so they've had 3 different houses all tied up with VA because they had that much entitlement. So yeah, pretty cool.
Yeah, thanks.
Yeah, it is folks, it is a fantastic loan for the military to have, because, you know, as you can imagine, no down payment is amazing. You know, it's completely backed by the government, you know, so it's guaranteed. And so it's a fantastic loan. But yet again, because the government's involved in it, they want to make sure that the house is up to snuff. And so they have a very thorough appraisal for VA home loans, very thorough, right? And they have this like, when you bought your house, right?
I had a dime sized, one of the list of things, but one was like a dime sized hole in my siding. And it had to be fixed, like everything, it had to be fixed. And the appraisal wasn't done early on in the process. I had like less than a week before closing and it had to be done. I was like, oh, hurry up.
Yep.
Ours was the
Plays
same
it, yeah.
way. We had to replace one whole side of housing siding
One whole side of the house.
because the way our house sits, the wind hits one side, so if something blows, it hits the siding,
Yeah.
like tree branches and stuff. So there was a whole bunch of dings in it, and they made it be replaced.
Yep, that's exactly right. Claire said the same thing. They had a hole in siding. And the reason being, yours was from drilling a holes holder in, tiny hole had to be replaced. Yeah, the reason is those holes can allow water penetration and that can cause wood rot. And so they're very particular about all kinds of things, folks. Same thing too. I'll tell you, you want to hear a funny story about the Department of Veteran Affairs? When they purchase a house because of default, I helped clients buy a house one time that was owned by the Department of Veteran Affairs. And as you can imagine, it's a pain in the butt buying anything from the government because my client had like 4 names. And so they made her re-sign the paperwork 6 different times because they're like, nope, she signed it with 3 initials instead of 4 initials. Nope, we need the hyphen in the initial. I mean, it was ridiculous. But here's the worst part. The house that they purchased had a deck and it had no handrails on the deck. And it was like high enough. And so a VA loan would never fund that. But ironically enough, the Department of Veteran Affairs also weren't willing to fix that. And so my clients, I think, were getting a conventional loan. And even the conventional loan wouldn't fund that. And they're like, well, we're not lending on this unless it has handrails. And the Department of Veteran Affairs is, we're not doing anything to that house. And so we were at this like impasse, like how the hell are we supposed to close on this house? I'll tell you the funny story. The husband is a carpenter by trade, and magically one night handrails just appeared on that house. I have no idea how they got there, but one day they were just there and they closed on the house. But I mean, it was just the craziest thing because you were like, well, you would have asked this to be fixed of any other seller. Why won't you fix this? And they're like, nope, we don't do repairs. Take the house.
I've got a question really quickly, Seth. So let's say my father, he was in the Marines. If he purchased a second home and did it through a VA loan, and I were to assume that loan, that's possible, right?
Yes.
Okay.
Yeah. They're assumable by anybody who's not a veteran. It's just that your father would, obviously his entitlement would be tied up in that house, even with you as the assumer. But yeah, absolutely legal. Yep.
In this case, even the person who is assuming, if they don't belong to any of the veteran status, are they still assumable, sir?
If they don't belong to any of the military, is that what you mean?
Yes,
yeah. They're assumable by people who are non-military.
Oh.
But I told you it's very rare because most people will not allow their entitlement to get tangled up for a nobody. Like Lene's thing is unique because that's family. And so that may be completely and utterly in them. But most people are not going to allow other people to assume their VA loans because it keeps their entitlement tangled up.
My dad did it for my sister, but that's because he wanted her not to be living with him anymore.
Well, if it happens, it happens, right? Like,
So for
That's funny.
regular assumable loans, what is that putting the seller kind of stays responsible for those loans, or
No.
off? But if it's VA, their entitlement.
Yeah, because the government has guaranteed this loan, the only way they're guaranteeing it is based off of some military member's entitlement. And so that doesn't go away when somebody assumes a loan. That entitlement is still tangled up in there with the government guaranteeing it. But in any other assumable loan, it's just an insurance policy that everybody else is going to assume taking over. And so they'll start making the payments. And so other assumable loans, not really a factor. The seller goes their separate ways. It only seller of a VA loan adversely because of that entitlement. Yeah, they don't have any legal liability to pay it, but if it doesn't get paid, it screws up their entitlement, which is, well, it's not a good idea to allow somebody to assume it. But all government-backed loans, it is illegal for them to have that alienation clause in them and the repayment penalty clause. Can't have it. That's the VA in a nutshell. Yet again, understand that the VA is not the one lending money. It's the individual banks lending the money. And then the government is just backing it with this guarantee. I will tell you this, in some really rare circumstances, like in very rural areas where there's not like banks and there's, military, sometimes the VA will lend money to people in very unique circumstances, but most often it's the banks lending the money, the banks setting the interest rates, and then the VA just guaranteeing those loans. When we're dealing with any of these types of loans, understand that we have what we call underwriting guidelines, and it's basically a recipe. It has to meet this criteria. It's kind of like somebody comes to you and they say, here's a recipe for a cake. If you make it exactly like this, I'll buy it from you. That's how loans work. There's underwriting guidelines that says, if you do this exactly like this, the secondary mortgage market will buy it from you. And so we're going to talk about the secondary mortgage market in just a second, but just understand that secondary mortgage market has nothing to do with these loans. This is what we call the primary mortgage market, what we're talking about right now. When you're giving money to the general public to buy houses, the banks who are lending the money is called the primary mortgage market. That's what most of us deal with. The secondary mortgage market is quasi-government entities purchasing these mortgages. And what that happens when they do that is they free up capital. If you think about it, $250,000 in your bank account right now, and you lent out all $250,000, you have no more money to lend, do you? Banks work the same way, just with much bigger sums of money. And so they will, have like, $1 billion to lend out that they borrowed from the Fed. And once they've lent all $1 billion, they can't do anything unless they get some of that money back. So they sell these loans off to the secondary mortgage market to get capital to keep lending. That happens. We're going to talk more about that in a second. I just went on a roll and I just started talking. So when we're dealing with the VA loans, right, that certificate of reasonable value, that CRV. Remember, I told you, you can buy the house if the CRV is less than, but you just can't get the full loan amount. You would have to pay for the difference out of pocket. They're only giving you 100% of the reasonable value as anticipated by these appraisal.
One more quick question, Seth. Sorry.
Yeah.
Do you have to live in the property for a certain amount of time before someone can assume the property if you have a VA loan?
Once again, well, for an assumption, no, it shouldn't, because it's still going to be owner occupied by the person who's utilizing it. So I can't say with absolute certainty, Lene, because that's an oddly specific question, but I would assume that it with an assumption period of time. But there is a time limit for utilizing it as non-owner occupied, because VA loans, once again, not designed for investment properties. They're designed for owner occupancy. Right? Once you live there a certain period of time, you can convert them to investment properties. But when you're buying it, they have to be owner occupied for a set period of time. Yeah. So this is just talking about the entitlement. The entitlement sets the amount of the loan the veteran qualifies for the down payment that the VA will guarantee. Obviously, if you wanted to purchase $1 million house, but your entitlement was only for $800,000, you can still get a VA loan, but you're going to be putting $200,000 down to buy that $1 million house. And that's how it works. If your entitlement and the CRV and your loan amount all work together, then they're guaranteeing the entire thing. No ifs, ands, buts, or coconuts. But sometimes your purchase may exceed, which is where, you couldn't get a true traditional VA loan because you don't have that much entitlement. So you would have to, in order to get a VA loan, pay the difference.
And the entitlement is just what you would get from when you need to get pre-qualified, or does the entitlement comes from the lender, not the VA, correct?
No, the entitlement comes from the VA.
Okay, so
The
you,
entitlement is how much guarantee. And so basically you have to use a lender that works with VA loans, and then they would have to communicate with the Department of Veteran Affairs to figure out what your entitlement looks like.
Okay.
Yeah. I've already said this, no prepayment penalty allowed. Assumptions are allowed for anyone, not just vets, as we said, as long as the borrower qualifies. That's always the biggest part of loan assumptions. You can't just assume it because the banks have to actually qualify you and make sure that you can afford it. You know, you got the same qualifications as the person who got that loan. And then I told you, once you pay that off, your entitlement is restored. So your entitlement is tied up to whatever limit you have until you pay it off. And once you pay that loan off, your entitlement gets restored, and you can wash, rinse, repeat. You can use your VA loan until you die. And then, you know, if you have a surviving spouse, they can continue to use it. So the best way to think about it is VA are guaranteed loans, FHA are insured loans, and conventional loans are private. There's no backing in any way, shape, or form. The lenders bear all risk in the conventional loans, but there are conventional and insured loans, meaning less than 20% down, you get private mortgage insurance. So that's kind of the differences there. The one that is not, this is just giving a scenario. This is military member who obtains VA loan, not any upfront closing cost. That means military members will have loan balances that exceed 100%. So in other words, if you had purchase $250,000, closing costs of $5,000, you could end up borrowing $255,000. They will let you roll in closing costs, but there is what we call a VA funding fee that they do not allow to be rolled in. You have to pay that at closing. That is something you always have to pay, the VA funding fee or something like that. I do want to mention the one other one because I don't think there's slides for it, and it's not as testable, but I just want to make sure you're aware of it. The other one, the other loan type that we always talk about, right? FHA, VA, conventional, and the last one is USDA. And USDA stands for U.S. Department of Agriculture. USDA, U.S. Department of Agriculture. And USDA loans were basically another government loan that they created to help increase population and utility of very rural areas. That's why it's the USDA, U.S. Department of Agriculture, because as you can imagine, in municipalities with very small, what's the word I'm looking for in my brain? The number of people that live there, what's the word for it?
Population.
Demographics.
Yeah. Yeah, there you go. If you're talking about a city that has not a whole lot of people living there, that means there's less taxpayers, there's less money, which means there's less ability for it to grow. And so USDA loans were created to help increase purchasing in rural areas. And so they basically have maps that are drawn out. You will not be able to use a USDA loan in a very populated area. They redraw the maps every single year. And you literally go to U.S.gov, put in an address, and it's either yes, this home qualifies, or no, it doesn't. That's how specific it is on areas. What you got, Catherine?
I was just going to say, I just really quick asked my friend who just does only VA loans, and she told me there's no longer a limit on how much you can borrow. It's based on your income and how much you can afford now.
Oh, cool. So they'll guarantee the whole amount, is what you're saying?
The whole amount, correct.
Qualify for it, huh?
Yep.
Interesting. Very cool. It's good to know.
Very.
Yeah, no kidding. Yeah, I by no means am I an expert on VA loans. I'm not military, so I've done probably 6 in my life. You know, and they've all been like those same 2 clients from just buying and selling different houses. There's probably been like 3 others actually, but so USDA, I don't think it shows up in the slides, but USDA is designed for growth in rural areas. The cool thing is about USDA loans, if the area qualifies for USDA, they are also 100% loan to value ratio for anybody, as long as it's in that area. Yet again, though, you can't make too much money. If you make too much money for USDA, they're designed for lower income and rural areas. So you can make too much money to qualify for USDA. But there are awesome loans if you do qualify in an area that, you know, that qualifies for USDA. So, let's talk about this for a second. This is seller financing is what this is. So this is something different. When we've been talking about these other things, these are from banks, but this is now referencing, it's called a purchase money mortgage. And this is what I like to call financing, true seller financing. So basically the seller becomes the bank, right? They are acting like a lender. And so you would purchase the home. And so what we say is the seller lets you borrow the money. Well, folks, they're not going to hand you $200,000 to hand back to them. It's kind of this concept of, I gave you the home because I let you borrow, you know, $400,000. And so you've got a promissory note to pay it back. And so just like the banks do, they would transfer ownership to you. They would take back a note and put it as a lien on the property. If you default, they can take the property back. So they are acting like a bank. This is seller financing. And they would charge interest too. So if they let you buy the property from them and make them monthly payments of, you know, $1,600 a month, you know, plus interest or whatever it is to hit a certain number, lien on the property. And this is what we would call true seller financing, called a purchase money mortgage. Now, here's one thing to know about North Carolina. In North Carolina, if anybody defaults under traditional financing, the banks can file a deficiency judgment. However, in North Carolina, if you have done seller financing, you do not have the option to file a deficiency judgment. Presumably, you, who gets owner of the home, who gets ownership back, is not hurt as much as the bank is. And so you can't file a deficiency judgment, but you do get the house back and could potentially keep all the equity that person paid you in a default.
Would that be considered like a hard money lender?
Not exactly, because a hard money lender is a third party. And so typically your hard money lenders are not the sellers. It's just somebody who's willing to give, it's not the bank. So, you know, it's a similar concept, but I just wouldn't use it in the same context because seller financing is not typically used in that terminology. Hard money lenders are typically a third party. Yeah. So there are times and reasons that this could arise. I wouldn't worry too much about the reasons why this would arise. Focus on what it is, right? So if you see the word purchase money mortgage on the test, it is a type of seller finance where the seller transfers property to you, lets you borrow the money, and you make payments back to them. They take a note and a lien against the property. I'm gonna say something else here, okay? And I need you to listen to me. I'm about to say something else that is not the same thing, but they're both very testable. There is another concept called a contract for deed, land contract, land sales contract, whatever you want to call it. And it's not the same thing. Some verbiages will state that that's another type of seller financing. It's not what you would call traditional seller financing. Seller financing means the seller's acting as the bank, and that's what a purchase money mortgage is. The land contract, installment land contract, contract for deed, it has a lot of different names, is basically like a layaway program. The difference is, here's the biggest difference, okay? In a purchase money mortgage, the buyer gets the title and the seller takes a lien against the property by way of this promissory note. In an installment land contract, also called a land contract, contract for deed, the seller retains legal title and the buyer has equitable title. And so the buyer would not get legal title to that type of property until they made their last payment. You see the huge difference there? Buyer gets legal title to the purchase money mortgage at the time. Buyer would not get legal title in an installment land contract until they made their last payment. Big, big difference there.
I have a question. With the purchase money mortgage, is there, and I might just be taking this too far, but is there still like a trustee? And like, is it considered the same kind of like 3-party deal?
Really, no. This is a little more straightforward. Understand too that a purchase money mortgage would need to be drafted by an attorney. And so there's some legal documentation that would go with it, and the property, you know, would have a lien on it, but it's not necessarily the way that the banks do it, because it is not a traditional type of financing where the trustee is involved, which is why there's those deficiency judgment rules where you can't do one, because it's a little more personal, right? Seller and buyer are the only parties kind of set up, no trustee.
But you still have the foreclosure as your ability to take the property and sell it.
And
Or do
so
you take
there's,
it back?
you just take it back. That's it. You don't foreclose on it. And that's why it's different. In the, you know, the bank scenario with the trustee, you know, foreclosure means forcing the sale, right? Everybody always thinks that foreclosure means I take ownership, but it's just selling it, forcing it to sell it at auction. In this, a default would just mean title goes to the bot or the seller. There is no traditional foreclosure, you know, process like this. And the questions that you're going to see more often than not are just, what is this? And when does the seller or the buyer get legal title, so on and so forth. Purchase money mortgage. Here it is, USDA loans to low income residents of rural areas, community up to 20,000 persons. So like I said, lower population. When I grew up in Fuquay, there was a period of time that there was outskirts of Fuquay that qualified for USDA. None of it does now, because as the area gets more populated, it kind of falls off, and they take the maps and rewrite them. And the only way to see if you can qualify for a USDA loan on a home, meaning it does the home qualify, to USDA.gov, type in an address and either say yay or nay. That's it. You can't be like, but please, doesn't work that way, right? Like, it's only if it's on this map.
Did you say that if the area does change, that they can go back and change your qualification at that point?
They're not going to change the loan that they've already underwritten. They would never do that, but they can change the map. So like, you know, if somebody, oops, let me fix this. If somebody buys a home, let's say in like the outskirts of Andrew that qualifies for USDA, but then the next year they realize that the population's where they want it to be, they may take away that Andrew doesn't qualify. So everybody who's in Andrew with the USDA loan is going to be fine to pay their loan like normal, but they're not going to issue any new ones in that area. Yeah.
A lot of areas in Chatham County that were considered rural are no longer rural too. My in-laws live like Jordan Lake area.
Mm-hmm.
And now there's not a house below $800,000 out there, except for the street they live on.
That area has blown up a lot, especially with the development of Chatham Park, you know, which I think is the Goodnights or somebody developing that. But yeah, that area used a lot of rural areas out there that qualified for USDA, and you're right, it's blown up, and it is not, right? Ever from like 64 on over to Pittsboro. I mean, it's a lot different.
And I remember when Fuquay was nothing but tobacco farms. And my grandparents sold a ton of land out here, like to the Walmart and places like that,
Mm-hmm.
all the apartment complexes. And nothing is rural except for the roads,
Yeah.
the traffic.
Yeah. Yeah, it's nuts how quickly that the qualifications can change. Catherine says their town qualifies. What town are you in, Catherine?
I'm in Richlands.
We'll say it again.
Richlands.
Richland?
Yes, it is a tiny, tiny town on the outskirts of Onslow and Jones County.
Yeah.
We're neighbors. I live in
I
Jacksonville.
know Richlands.
Wait, where are you at, Sheena?
Currently, I'm in Jacksonville.
Yeah,
Jacksonville?
it is. tiny, tiny, okay, we just got excited because we got a Tractor Supply and an Arby's, okay?
Whew, moving on up in the world, right? Tell you
Yeah.
what, Tractor Supply loves rural areas. They're always like the first big business in like, rural areas, and then everything builds up around it. Once you get a Tractor Supply, you're going to start up and coming,
Yeah, well.
That's
for
what
about
happened to
6 months out
Fuquay.
of the year, it stinks here.
Yeah.
It's like,
Yeah.
it's bad.
Mm. Georgia, you're right. That is what happened to Fuquay, right? You got that Tractor Supply right in the heart of it. Now it's just blown up, right? You get a Tractor Supply and everything else comes after. Plus the 32 mattress stores in in Fuquay, right, Georgia?
Oh, yeah. And where I live, when when I moved here like 17 years ago, I actually live in a rental house that my parents own because they would rather me take care of it than, the house fall apart from the renters. This house rented for about $500 to $600 a month. Now, there's not a house on my street that rents for less than like 17. And these are not like
Right.
big, nice homes. They're like little mill homes. I live over by the Aviator and stuff. And these houses are all built in the 20s.
Mhm.
They're all tiny little houses. And the property has like tripled in value.
It's nuts, right? I mean, it's happened everywhere, which, it's good and it's bad at the same time because it just happens so rapidly and, sets this area. But, even in like the sticks of Georgia where my house is, like I was talking to a guy at the gas station the other day. Apparently it's happening everywhere. A lot of people, are just moving to all these different places where it's been affordable. And as this influx happens and it just drives the prices up. Even here in Panama City Beach, because as a real estate agent, I was looking, right? I'm like, man, I could buy a house here. I was talking to a guy at one of the restaurants last night. He was like, man, don't do it. He's like, for $150,000 6 years ago. And in his neighborhood, the cheapest thing I could find was $450. And we're talking like 1,200 square feet, but I mean, it's the beach. So, yeah, it happens. So in the last 15 minutes we have before we get to your lunch break, let's talk about different types. Now, this is where I was talking about the flashcard level stuff. Like this is just be able to tell me what it is. Okay. This is not going to be in-depth questioning, excuse me, in any way, shape, or form. It's not analytical. It's not going to be tricky. It's just recall what this is. And so there's a lot of different loan types. And when we say loan types, I don't mean loan programs, or like the USDA. What I mean is like your repayment structure intending to do. So we've got construction loans we need to talk about first. Now, construction loans can happen 2 different ways. An individual person can get a construction loan and they can use it to pay a builder to build them a house. But more often it is done to, builders. So be careful of the context, because if a builder is doing it, they're getting a construction loan. And here's the thing, when you borrow money, the bank you to pay what?
Interest.
And so here's the thing about construction loans. If you were going to borrow $500,000 to build a house, folks, a house doesn't go up overnight. And so you do not need all $500,000 up front, because they're going to start making you pay interest on the $500,000 as soon as you have it all. So construction loans are designed in what we call draws, where you get what you need at the time that you need it, and you just start paying interest on that amount. So for example, whether you be a builder or a homeowner, if you did the grading for the foundation, it costs $10,000. You get a draw of $10,000 and pay them. If you did the foundation, it costs $20,000. You get a draw for $20,000 and you pay them. You get a draw for framing of $15,000. And so the idea is that you're not borrowing the money up front. So that way you're reducing the amount of interest based off of how much you're borrowing. If you were a buyer and paying a builder, typically what would just happen is you would have already paid the builder all their money, and the amount that you borrowed, like that $500,000, would just then convert from a construction loan to traditional financing, right? It would convert to like a 30-year fully amortized loan. So just be aware that construction loans typically are done in draws. Builders could do them for themselves as a business. Individual homeowners could do it to build their own houses. Just be very careful in how the question is worded. And it says most risky type of loan because money is being loaned before the home is complete. Well, yeah. I mean, what happens if the home never gets complete? It does happen, with both builders and homeowners because, maybe they don't qualify for it anymore. And so you got half a house built, but nowhere to get money from. And then all kinds of legal battles ensue. So they're pretty risky because of the nature of them. But general people can qualify for them, and so can builders, called a construction loan. So this is where you'll just have to have the ability to recall, right, what a construction loan is, be able to tell me that has to deal with, draws and purchasing or building a home and, can be converted to a full-time loan after you do your last draw, so on and so forth. So then we've got another type called a blanket loan or a mortgage. And so I want you to think about the word blanket. If you were to take a blanket and toss it somewhere, it could cover a couple of things at one time, in most cases, right? And that's why we call it a blanket mortgage. It is something that covers more than one thing at a time. So this is very common for developers to use. If old man Farmer Jones was selling his 80-acre parcel on one side of the road and his 40-acre parcel on the other side of the road to a developer, a blanket loan to purchase both parcels in one loan because they're going to be developed together. And so it's just one loan for multiple parcels of land. It's called a blanket loan. The other time that you could be considering something a blanket loan is, I just want to make sure you understand this. So let me talk for a second. A lot of people get confused when we're talking about a developer. A developer is the person who purchases the land, cuts in the roads, facilities, lays out the lots. And sometimes the developer and the builder are the same person, and sometimes they're different people. Builders make money by building houses and selling to the public. Developers very often make money by developing lots and selling them to builders. So while a developer could get a blanket mortgage to purchase two parcels to develop, a builder could also arguably get a blanket mortgage to do what's called a takedown, where they purchase like all of phase one of a subdivision that the developer developed. Inception-y. So like all of lots 1 through 20, they could get a loan to buy all of lots 1 through 20 as a builder. That could also be a blanket mortgage, right? That's all it is. It's just a loan that covers multiple parcels of land. Blanket mortgage, blanket loan, either one. So this one, a package loan. And what a package loan does is it basically lends and helps you purchase both real property and personal property simultaneously. And so if you were purchasing a beach house that was fully furnished, you would probably have to get a package loan, because the idea is most loans are not giving you any value for personal property. And so they're not going to cover anything outside what the house is worth. A package loan could personal property, and so they would maybe lend you more because it is coming fully furnished, or maybe you're purchasing a house that includes a boat slip or a boat. That would be a package loan. It is a type of loan that funds for both real and personal property simultaneously. When you're purchasing a conventional home, you're not getting any personal property. It is covering the house only. So you would need a package loan if you're getting any personal property with it, at least above and beyond the norm, right? Refrigerator, washer, all personal property, and they're allowed to convey without any issues in a conventional loan. You would not need a package loan just because you were getting those things. This is just used when there's a lot of personal property that has a lot of value, like fully furnished boat, something like that. I will tell you there is another type of kind of package loan that, special, well, we haven't really talked about this yet, but let me go ahead and put this out there. A manufactured mobile home, also called a trailer, considered personal property. It's got a VIN number, just like your car does, and your car is personal property. So sometimes you also get a package loan to purchase land and your manufactured home simultaneously. And you would get the money to cut in a well and do all these things. So that sometimes a package loan is utilized in that regard as well. Some other special types of loans, bridge loan. If you think about what a bridge does, it connects one thing to another thing. That's what this does too. This is designed when you want to pull some equity out of your house, or basically lend money on equity you have. For instance, if you want a home that has $250,000 in equity and you're trying to buy a new home, but you want to buy that new home before you sell your old home, you could get a bridge loan, which would basically lend you like $100,000 that you could use as your down payment on that other house. And then you would pay off that bridge loan after. So it's basically two things connecting, right? They give you, it is typically a shorter term, higher interest rate because it's not designed to be long term. They let you borrow money based on your equity that you're going to pay off when you sell your house. Very common to bridge from one property to another property by getting this loan to get cash from the equity you have, called a bridge loan. A reverse mortgage is kind of contradictory. It is not a mortgage. It is where an older person has paid off their house or most of it. And what they do is they start borrowing money against the equity in their home. And so it's some way that, you know, older persons can get living wages. If you own your home that's worth $400,000, you can agree to have a reverse mortgage with the bank. So as opposed to paying them $1,400 or $1,500 a month, they'll pay you $1,500 a month. Now, the problem is they typically work out a deal that, you know, when you die, the house is sold and, you know, they get their money back. And so if you were intending to leave that house for your kids or anything like that, the reverse mortgage is not a good way to go, because the banks will probably require it to be sold or all that money to be paid back, but it is a thing. And then there's also a HELOC. HELOC stands for Home Equity Line of Credit. Home Equity Line of Credit, HELOC. And so it is, once again, where you use that in your house and you get basically a revolving credit. You can just spend and then pay it back, spend and pay it back. Allows the borrower to borrow against the equity that is built up in their home over time, open-ended, which means the amount of the loan is not set in advance. So there is nothing saying that you're borrowing $100,000. It's basically, well, we've got this much equity, and so they'll give you a home equity line of credit up to $200,000, which means if you wanted to use it up to $50,000, you could. If you want to use it up to $100,000, you could. There's no preset based off the amount of equity in which you agree to the banks. This is another thing that people will often do to buy a new house. And they'll get a home equity line of credit on the equity on their old house so they can use it for like $100,000 down payment on their new house. Then they would just pay off the HELOC when they sold the other house. Very common. It doesn't have to be used that way, but that's all it is.
Does that refinance your house if you take out a HELOC? Is that refinance your current mortgage?
Not typically. It depends though, because it depends on, you know, the way it's sitting. What sometimes will have to happen is what's called a subordination agreement, because when we're dealing with liens on your property, they are first come, first served, first recorded, it's paid out first, and then so on and so forth. So sometimes the HELOC may require a subordination agreement to say that they're in the first position versus your senior mortgage, and so it would put it as the junior mortgage, but it's not typically a refinance in and of itself. It depends on the lender though. Last slide I'm sure I'll get to before I send you off on your lunch break. Subprime financing. This is what was happening a lot in 2007, 2008, 2009. And so we had a really big market crash because of this. And so let me just paint a picture for you. Have you ever seen that meme on the internet with the 3 different Spider-Men just pointing at each other? Yeah, they're like pointing at all 3. If you haven't seen it, it's just 3 Spider-Man from like an episode of like the cartoon, and they're all pointing at each other like, who's the real Spider-Man kind of thing. Well, this is kind of what was happening back in 2007, 2008, 2009, because real estate agents were acting a little bit shady back then. Lenders were acting a little bit shady back then. Appraisers were acting a little bit shady back then. And so they all pointed fingers at each other, trying to play the blame game on why the market went to hell in a handbasket. But one of the biggest pieces was this subprime financing. And so basically, if you had and could sign a paper, they would give you a loan back in the day, right? People who are very much not qualified, right? Working at McDonald's making $7.25 an hour, getting a loan for, $600,000. It just was not a pretty picture. Things were bound to go awry. And the other problem was appraisers could be picked. And so when a real estate broker said, oh, this person wants to buy this house for $500,000, they could pick up the phone, call their favorite appraiser and say, I need $500,000 on that. That's not how appraisals are supposed to work. And so all of this subprime lending and people being in each other's pockets and things not happening the way that they were supposed to happen caused the market crash of 2007, 2008, 2009, which led to the big financing reform of the Dodd-Frank Act in 2009, where we basically said, well, who the hell was policing this? Because TILA and RESPA have been around for over 60 years, I think. They're in like the 70s came about, but there was nobody enforcing them to the level that they needed to be enforced. And so they created the CFPB, the Consumer Financial Protection Bureau, as the oversight agency of 7 different government institutions, including the Fed and, overseeing RESPA and TILA and all this jazz. So subprime financing, less likely now, meaning buyers are very well qualified nowadays, but that doesn't mean that you're getting the best interest rate in any way, shape, or form. And so just something to be aware of. Oh, which takes us to this. And I'll tell you what, we've already talked about a lot of this when I gave you the rundown last week. So hopefully you should be in good shape. So I'll let you go ahead to lunch as opposed to starting this 12 o'clock, 12:45. You lovely folks have a lovely, lovely lunch break, and we will do it all over again when we get back at 12:45. All righty. Sorry about that. So let's keep going with this financing jazz and talk about the next couple of pieces. When we get into section 6.3, this is getting into more of the function of what the payment looks like. So we've talked about loans, we've talked about some basic qualifications. This is where we're going to go into a little more detail on the, repayment, what it looks like. And I told you last week how it kind of works and the pity payment and explain it. And this is where it'll make a little more sense, and we'll dig into it a little bit deeper. So can everybody see the screen that says section 6.3?
Yes.
Cool. So when we're dealing with the loan payment, this slide is going to pop up 10 million times, but let me remind you before we go any further what I told you last week. When you're making your monthly, even though it's not a mortgage payment, that's what you call it. So I'm not trying to trick you. You make your monthly mortgage payment, even though it's a misnomer. It is a pity payment, PITI, principal, interest, taxes, and insurance. And I told you only this portion of it goes towards what we call amortization. Amortization is paying back the loan and the interest. And so there's a fully amortized loan is what most of us get, which is saying the first payment and the last payment and all payments in between are the exact same amount. And when you make the last payment, a fully amortized loan will result in a zero balance. That is what a fully amortized loan is. So principal and interest is what goes towards amortization. But taxes and insurance is something that you pay each month, whether you realize it or not, that goes into an escrow account for the banks. They hold your money and they make those taxes and insurance, both hazard insurance and private mortgage insurance, if applicable. Well, if you had a $1,600 a month total payment, and we said $1,200 was your interest and $400 went towards taxes and insurance. Remember, this number that's principal and interest, $1,200, will never change. Taxes and insurance can change because 30 years is a long time. Your taxes can get reassessed, right? The rates can change, your insurance can change, but principal and interest will never change. And so what this slide is showing you is, even though you were always paying $1,200 of that to that principal and interest, and please understand this is just a number, right? I'm not saying you're $1,200. I'm just picking an arbitrary number as an example. If this is what your breakdown looked like, you're always paying the same amount, and interest gets paid first, and then everything that's not interest goes towards your principal. So interest gets paid first, and then everything that does not go towards your interest gets paid towards your principal. Happens just like that every single month. So when we're dealing with interest, banks make their money off of charging you fine folks interest. And that P&I, right, that principal and interest is what goes towards debt service. Remember, paying down your debt service, I said, was one way for you to increase equity in your home, right? When you pay down that debt service, you gain more equity because the amount that you owe is less. Are we taking a picture together? Is that what's happening here or something? I would have posed if you told me, right? Yeah, Douglas said the same
I
thing.
was
Right?
over here cracking up. I couldn't focus on you because I was watching Mary take the selfie of all of us.
I'm like, we all would have posed, Mary. If you would have told us, we would have smiled.
I apologize. I'm so sorry. It's just, like I said, this is like my second time go around, and I'm confident because before I wasn't, and I was like, oh, I can't do it, but I feel great. I have a lot of people that's on social media that's rooting for me. So I'm just showing them, hey, I'm, if you want to do this is like sign up, you guys, it's great. It's fun. And I apologize. I didn't know y'all could see me. I thought it was
No,
like
you're
a
fine.
mirror.
We're picking on you. We knew exactly what you were doing. It was just funny because we're all just like, geez. Yeah, you're all good.
Well,
we knew what you were doing.
Yeah, well, you look good, Seth. So you don't got nothing to worry about.
Thank you. The beard is just getting extra gray after the sun. So I was making sure I had my good side of my face on the camera, So
yeah, it looks good. It looks good on you.
Okay, thank you. So when we're dealing with debt service, okay, principal and interest goes towards the debt service. Remember, taxes and insurance are not going towards paying your loan at all. So even though you're making this monthly payment, there is a portion that does not touch the bank. It's going to pay your insurance and your taxes in upcoming years. And so the debt service is just the P&I, which is what makes it so confusing, because when we're talking about housing expenses and from a qualifying point of view, the total pity payment plus HOA is accounted for in the housing expense. But if we're talking about amortization or debt service, all we're talking about is the principal and interest amount, whatever amount of your pity payment is going towards interest. So principal is just the amount that you borrowed. If you borrow $250,000, that is your principal balance. And as you pay that down, your principal balance goes down. So understand this: when you have your principal balance and you get a loan, amortization is kind of an interesting thing, because what happens is very early on, you are paying a lot of interest, and a very small amount is going towards your principal payment. And as time goes on, it shifts, because remember that the $1,200 or however much your principal and interest payment is will never change, but the amount that's allocated towards interest, the amount that's allocated towards your principal will eventually shift a little after halfway through the loan. So you'll start making much heavier principal payments and much lower interest payments. But in the beginning, it is very interest heavy, very. So let me explain a very important concept for you from the mortgage, from the loan payment kind of point of view. When we're dealing with mortgages, your interest is paid in arrears. And so what that means is if you make your June 1st or your July 1st payment, you're paying for the month of June. Okay. If you make your February 1st payment, you're paying for February 1st, January, March, February. So let me show you this. If you were closing on a house on, let's just say, March 20th, your first payment is not going to be due in April. It's going to be due in May. And when you make May 1st payment, the general rule is pay anywhere between the 1st and the 15th, right? It's due on the 1st and it's late if it's after the 15th. When you make that May 1st payment, you are actually paying for the interest in April. That's what it means to be paid in arrears. And so that's how it will always go. Well, one of the reasons why this is so important, folks, is because the banks are in the business of making money. So let me ask you a question. If you make your first payment on May 1st and they get April's interest from that payment, when are they going to collect the interest for the rest of March?
At the closing.
At closing.
At closing, it is called interim interest for a borrower, right? What is called interim interest. And let me word it this way. It is interest you pay in the interim of your amortization schedule kicking in. Okay, that's why we call it interim interest. And so mortgages are paid in arrears. Now, let me make sure that you understand. Rents are paid in advance. When you're renting and you pay January 1st rent, that's to live there for the month of January. When you pay February 1st rent, that's to live there for the month of February. When you pay March 1st rent, that's to live there for the month of March. So rents are paid in advance and mortgages are paid in arrears. Okay, advance versus arrears. So when you're dealing with paying down your principal and your loan and your amortization, only that principal and interest, that P&I goes towards amortization, but it is paid in arrears. This is more confusing than it needs to be. Let me think of how to word this because it's hold on. I'm going to circle back around. I think that slide's more confusing than it needs to be. It's going to make you think some things that shouldn't be thought. When we're dealing with that interest, okay, I'm going to just explain. Oops, I just changed that the wrong way. There we go. When we're dealing with it, I just want you to think for a second with me. What's on here? I just want to talk to you. When you're buying a house, say that you're closing on March 25th, like I said, you would have to pay interest, including the day of closing. The bank say, here's the money that you can borrow on March 25th. And they make you pay that interest from March 25th through the end of March at closing. And we call that interim interest. But when we're dealing with a seller, you've got to understand that if you were selling your home March 25th, they normally would have gotten March's interest when?
April 1st.
April 1st, but you're not going to make that payment. And so they're going to collect what's called accrued interest from the seller at closing, which is why if you look at your bank statement and it says your principal balance is $250,000, that is not the same thing as your loan payoff, because your loan payoff has to include the interest that is accrued as well. That's what I was trying to say in just a very confusing way. And I'm trying to explain it. So I'm going to show you some examples of this math in just a moment, because we do have to calculate this math. Now, let me remind you of something very important in this class. That is so weird. I'm not losing my mind. This clicker, for whatever reason, is magnetically sticking to my keyboard. And I was not under the impression, or like on my laptop, I was not under the impression that this was magnetic in any way, shape, or form. And I think it caused the slides to skip a second ago. That's crazy. I did not know that was a thing. Anyway, I digress. That's why I'm looking around like a crazy person. So we're going to talk about the math with this interest, but I want to remind you in this class, everything is 30-day months and a 360-day year, everything. But this is for, I'm going to be the bearer of bad news because Travis just instills it so much in your brain that, you know, most people who take Travis's class, who come to my post-licensing classes, have PTSD about it. But let me remind you, for the sake of this class, every proration, everything that deals with time, 30-day month, 360-day year, always, always, always in pre-licensing and on the pre-licensing test. When you give us licensing, we do real calendar year. So just keep that in mind so you don't have this crazy shock value whenever you get post-licensing. But everything is going to be 30 days for the sake of your calculations in this class, 30 days and 360-day month or year. So when I use this word amortization, all amortization is just a funny word that says making equal payments and paying off your loan with interest calculated in it. Because if I said that you have a 30-year fixed rate, 3.75% interest rate loan, it would be impossible for any of you to tell me what that actually equates to just by saying that. And the reason is amortization is a very specific type of math because of the way that it calculates interest and the way that it uses simple interest. In other words, we charge you interest on your principal balance. Well, when you make your first payment, your principal balance goes down. And so every single time you make a payment, your interest that you're getting charged each month also goes down. So because of the nature of the way that we're charging you interest on something that keeps changing, amortization is a very complex concept. So most mortgage loans are amortized and they're also fully amortized. And I'll remind you what that means. It means when you make your first payment, every payment in between and your last payment, that the principal and interest amount was the exact same. And when you make the last payment, your balance has been reduced to zero. That is what fully amortized means. Well, folks, if you've got a 30-year mortgage, how many payments are you making?
360.
360. 12 months in a year times 30 years would be 360 payments. So in other words, in a 30-year fixed rate loan, you would make 360 equal principal and interest payments. And when you make your last one, the 360th one, your balance will be reduced to zero. That is what a fully amortized loan does. So that amount never changes, but the way that it's allocated is, and this is where I'll remind you, whatever your principal and interest amount is will be the same on payment 100, 200, 300, 360, and 1. The payment's always the same. But they always pay the interest you owe them first. That's taken out first. And then whatever is left goes towards your principal balance. And this was where we did that math last week to show you how that amortization math works. If you had a principal balance of $200,000 at 4.25% interest, and your principal and interest payment was $1,200. Oops. Let me just show you how this works. And this is going to come up in some other examples. I just want to give it to you really quick. Simple interest means you just calculate the loan amount, and interest is based off of loan amount. So loan amount of $200,000 times your interest rate, 0.0425. You can have the calculator commit it for you, but that's 4.25%. Would give you annual interest of $8,500. But here's the thing, folks, are you paying a year's worth of interest each month? No.
No, just a
You're
month.
paying how much?
A month's worth.
Yeah, it seems silly for me to ask that question, but I need you to say it out loud so you get your minds right. You're paying a, say what, Catherine?
So the first one's gonna be $708 divided by 12.
Oh, yeah. So yeah, I didn't need you to actually find the number. I'm about to work that out with you, but yeah, that's perfect. So here's the thing. You're paying a month's worth of interest, not a year's worth. You always got to think about this, right? Use some common sense when you're looking at these math problems. So that's our annual interest as it sits right now. You would just divide by 12 to figure out your first month's interest. And so in this scenario, if you're making your your principal and interest payment of $1,200 each month, remember I told you, when you make your first payment of $1,200, they're going to pay interest first. Well, that's what this number is right here. We just calculated it. Found your annual interest, we divided by 12. So you would have your interest first. And whatever's left goes towards your principal. So $1,200 minus 708.33 leaves 491.67 that would go towards your principal after payment number one. So in other words, 200,000 minus that 4.25. So we can make our lives easier. Interest rate 4.25 we'll put right here. So 200,000 minus 491.67. Fix that. Which means after we made our first payment, $200,000 minus 491.67. Our new principal balance would be $199,508.33. And this is exactly what's happening every single month. You make a payment and they get their interest first, and whatever doesn't go towards their interest goes towards lowering your principal balance. And so when you make month two's payment of $1,200, same P&I payment, but the way it's allocated is different because now you're doing it on this new balance. Your new balance times your interest rate of 4.25% gives you your new annual interest divided by 12, gives us the monthly interest. So now where we paid $708 in interest on month one, we're now paying $706 on month two. And it just keeps going. Folks, if I did this, if this was a 30-year, did this math 360 times, when I do it the last time, it's going to reduce it to zero. So this is amortization math. It's just every single month your interest goes down, and so you have to start over. What is the new principal balance? Times your interest rate divided by 12. And that's how much is going in each month, which is why I told you when you make your first payment, right, very interest heavy and very low on the principal. But as time goes on and you paying down that principal balance, the increases and the amount that goes towards your principal increases until eventually it'll tip the scales and it'll start being very principal heavy and very low on interest. That's how amortization works. Everybody understand what I just did there? Somebody raised their hand. Does somebody have a question? What you got, Lydia?
I don't have a question.
Oh. No worries.